Welcome to Yahoo Finance Live. I'm Brad Smith alongside Akiko Fujita today here at the NASDAQ in Times Square. Happy Jobs Friday to all who celebrate. We certainly do, and we're glad you are with us. It's that time again. Economists are looking for 180,000 jobs added in October. That would mark a notable slowing from September's blowout report. The big question this time around, though, will strike action in the United States distort the number? Probably. That's thousands of workers not accounted for in the number, but to what extent is the big question here. The unemployment rate expected to hold steady. We're also watching that all-important reading on wage growth as the Fed's pause continues to capture the market's attention.
Yeah, I mean, when you consider just what a blowout number we got back in September, I mean, the expectation here is that things would have sort of slowed back significantly. The UAW number, as you highlighted, Brad, is going to be really interesting to me because we're still sort of assessing the impact, right? When you think about the big three, what that has been as well. But as we have seen from even the Hollywood strikes as well, that has been highlighted over the past few jobs reports. So one number to be watching really closely. And the 3.8% are expected to hold steady, but interesting to see the market reaction if, in fact, we do see it tick up, because we have heard from Chair Powell consistently saying the labor market has been surprisingly resilient.
Right.
Is this the one where we finally started to see tick down?
A range of data and commentary that we got this week, and especially around the labor environment right now. When we think about even the commentary that we got from Fed Chair Chair Powell, who had talked about wages, and we're looking on our screen right now at this average hourly wage expectation increase. That's the year-over-year figure here. And saying that ultimately wages weren't the biggest thing that were driving inflation right now. However, it's still a consideration. We heard similarly, even within the ADP research that had come through over the course of this week too, where wages, you also saw that continue to move higher. So all of this considered, there is that conversation about wages being involved within the broader inflation concern. But at the same time, that's not the chief thing that's driving inflation right now.
And we're going to get that print right at 8:30. But the other big story we are watching this morning is, of course, Sam Bankman-Fried, found guilty on all 7 criminal counts there, including fraud and conspiracy. He faces over 100 years in prison for the charges. His sentencing is set for March. And of course, Brad, we're talking about the founder of FTX, sort of tough to overstate just what a stunning fall this is. I mean, you think about just over a year ago, right? I mean, he was at the top of the crypto world. Now he faces what essentially amounts to life in prison.
It's remarkable for the figures that had really emerged as some of, if you may say, the barons of Bitcoin or some of the czars of cryptocurrency. Overall, if you look for those figures right now, where are they to be found? And the larger question going forward from here is what the confidence in cryptocurrency among the masses that have, some of people have placed their life savings into it. Other people have decided to put some of their portfolio in it, but recognizing how risky of an asset it was, and also how risky of an asset it can be when you have some of the biggest whales out there, or at least those who are driving not just the conversation, but the flows that are going both into and out of crypto when they get involved in some of the more, not just questionable, but guilty charges such as this with Sam Bankman-Fried. Do Kwon, you were mentioning earlier today, where is he even? We don't know.
Yeah, I mean, what does this all mean for other crypto players, the crypto sector as a whole? I mean, we still have to talk about regulation as well. We're obviously going to be breaking that down throughout the next 2 hours, but worth noting here that the jury just deliberated for roughly 4 hours. I mean, that is a pretty swift verdict there. And some would argue, and legal analysts certainly pointing to Sam Bankman-Fried's own testimony, his decision to testify certainly didn't help his cause.
No, and the fact that he had multiple of his associates also testifying against him, and for them and their pleas, and ultimately how their sentencing will move forward from here too. You imagine how that's going to be playing into the overall sentences that they each get.
Yeah, I mean, they're not expected to be sentenced until late 2024. Right. So story far from over. One we're going to continue to follow as well. It's going to be interesting to get, what we hear from our guests today specifically on that. But going from $35 million penthouse, right, just about a year ago to now life potentially. I mean, he has said that he will indicated that they will likely appeal.
Right. Our David Hollerith was just in the Bahamas at one of the events that had taken place here. We're getting closer, though, to the October jobs report figure here. Of course, just a reminder, we're expecting 180,000 jobs to be added. Futures going into this report mixed as of this point in time, so we're going to be watching closely to see exactly where those figures come in at. And as we are getting that figure, it looks like 150,000 jobs were added during the month of October. Reading into some of the other data here as we're getting the change in non-farm payrolls coming in, that headline figure, as we mentioned, 150,000. And then additionally here, taking a look at the unemployment rate, that ticks higher to 3.9%. Average hourly earnings month over month, that was up by about 0.2%. Average hourly earnings year over year, that figure hotter than expected. It was up by about 4.1% here. You're taking a look at the futures once again here on your screen. We've seen a little bit of the movement. We were mixed. Now all three major averages here in the U.S. are in positive territory. Fractionally as it may be, we're seeing gains of about 0.3% on the Dow, about 0.25% on the S&P 500, and about 0.1% on the NASDAQ right now, too.
Yeah, obviously watching bond yields really closely on the back of any reaction to this as well. As we look at the 10-year here, we have seen it really pull back this week, by the way. It is at 4.5% roughly. The shorter end of the curve, we're seeing 3-year at 4.69. And the 7-year, or the 5-year, I should point out, at 4.5%.
I've also got to look at some of the sectors. You guys know I love talking about sectors. The job gains occurred in healthcare, government, and social assistance. Those were the drivers here. But employment did decline in manufacturing due to strike activity. That noted within the first stanza of this report. So there was that question of how much strikes would actually impact this figure. Seems as it did, it came in lower than expected here. And ultimately, a bit more of the data we're going to be able to dive into here just within the next few minutes. The labor force participation rate, though, that is at 62.7%. That was a slight tick higher from the last report as well. Let's get over to Yahoo Finance's Jared Blickery now to see how stocks are reacting in the pre-market. Hey, Jared.
Hey there, I am looking at liftoff right now. This is the NASDAQ 100 futures since midnight, and you can see we actually have quite a bit of big spike up right there. Let's take a look at the Dow. We swung from negative to positive in the NASDAQ. Dow is positive just before, and it is up about 101 points in the pre-market. And let's take a look at S&P 500 futures as well. Went from red to green, and we have them up 1/3%. Now, I was just looking at the Treasury market. We're seeing some pretty big moves there. This is 2-year Treasury note futures. This is the price of the bond. This moves inverse to yield. So we have this big spike up there. That is relief. That is a lowering of rates, and that's what the market has been looking for. We've seen Treasury rates kind of ameliorate. They had been giving the overall risk markets quite a bit of pressure, and it looks like that is continuing to be a relief valve for the markets now. Here's the 10-year T-note futures. Those are up precipitously, up 0.6%. That's a pretty big move there. So we're going to be seeing that reflected in the futures to the downside. And then let's take a look at gold. Gold may be pricing in a little bit more price inflation as the Fed is able to lift its foot off the brake. We're seeing gold up about 0.75%. Here's a look at the year to date. It really picked up recently. I was writing about it in our morning brief today. So technicals lining up for a potential bullish breakout. But I'll tell you what, you look at a 5-year basis, still got some work to do before we get out of this 5-year sideways trading action. All right, just want to check out silver real quick. Looks like we got a spike there as well. And then in the pre-market, well, I know, Brad, you said you like sectors, so we're going to take a look at the sector action in the pre-market. This is what happened yesterday, but I'm going to throw on the pre-market quotes, and guess what? We have just about everything in the green. Consumer discretionary, which was up 2.61% yesterday, that's down 0.3%. But real estate up over 1%, utilities and financials up more than 0.5%. So is industrials, by the way, in the pre-market going, guys.
Okay, Jared Blickery with the first market reaction there on the back of those jobs numbers. Jobs growth slowing, by the way, but the unemployment rate ticking up. Let's bring in Dana Peterson, the Conference Board Chief Economist, and Joe Brusuelas, RSM Chief Economist, to discuss this morning's jobs report. Joe, let me start with you. The number coming in weaker than expected. What stood out to you in the numbers that we got?
Well, it's another rock-solid American jobs report, right? Even if it did come in below consensus, I think that's a good thing. We did need to see jobs hiring slow. You know, we saw 33,000 jobs sort of adjusted for due to the auto worker strike. So the top line number actually understates the true pace and the overall scheme of things here. Look, right now, firms are having a much easier time attracting labor. We're not at that point where we can call this a red hot market. The trend is cooling. It's what we want to see. It's why bond yields are falling. It's why inflation is easing. Look, I think when we get into this, too often we fall into these false dichotomies of recession versus soft landing. I think what we need to do is start talking about this as it is. This is a very solid American economic expansion featuring historic rates of employment and a very low unemployment rate. Look, average hourly earnings, they're easing 0.2. Take a look at the 3-month run rate on that. You're going to get much more friendly economic and financial outlook. So I don't see here much not to like.
All right, Dana, Joe says rock solid. What say you?
Well, I still see three stories in the labor market. You have the companies that are letting folks go. There are companies that are hoarding, and then the companies that are still hiring. And it's still the same story. Companies that are letting folks go, those are the pandemic era darlings, and they're letting people go, such as finance and certainly transportation and tech. And that's understandable because they overhired and now they're right sizing. When you look at the jobs that are increasing, again, it's those jobs that are in person, or they're still trying to ramp up after the pandemic. That's government, healthcare, leisure, and hospitality. But in the middle, you still have a lot of hoarding. So this is the same story we've been seeing over the last few months. But we do think that we're going to continue to see softening in the labor market on the back of the Fed's extreme tightening of monetary policy. And we actually think that we will land in a short and shallow recession in the first half of next year.
Joe, you said there's not much to not like in this report, but how do you think the Fed sees it? I realize it's not just one data set they look at, but things pulling back just a little, right?
Right. They see a slower pace of hiring. We got a downward revision of 101,000 over the past couple of months. Yet people can get jobs very quickly. I noticed the median duration only 8.9 weeks. So roughly, if you're out of a job, you're getting one within 2 months. I mean, even before you get that first unemployment check in many cases. So I think the Fed's going to take a look at this and say, yep, you know what? This reaffirms our pause in November. I think it points towards an extended pause. The truth is, I think the Fed's done hiking rates. They will and they should at one point just get on with it and begin to think about stabilizing real rates, bringing down long-term borrowing costs for commercial and industrial loans. Our clients tell us they're paying double digits to finance payroll and expansion. So there's a lot of work left to be done. But as Jay Powell said at the end of his meeting, we're very close to the balance of risk being evenly distributed. That's inherently a bullish case for the American economy. And it's why, frankly, we just don't see a recession here right now.
Dana, how does the consumer see things? I mean, coming from the most recent Conference Board release that came out this week, consumer confidence regarding the employment situation, slightly fewer consumers were saying that jobs were plentiful compared to September. Numbers saying jobs were hard to get also declined. If the consumer is reading through this employment situation, what are they to take away from it?
Well, consumers are saying that jobs are hard to get and they're not as readily available. And that's consistent with what we've seen with the JOLTS data where, yes, companies are pulling down those job ads. And I think a lot of it's because, yes, you have some companies that are letting folks go, but most of them are holding on to workers. And I actually think there is one thing that the Fed wouldn't like in this report, and that's the fact that wage growth is not slowing. And that's reflective of the fact that companies are holding on to workers and they're advertising higher wages and raising benefits and comp and all those things to keep those workers. And that's all linked to labor shortages. So I think the labor shortage issue is leaning against the work that the Fed's trying to do to slow the economy.
Dana, when you think specifically on wage growth, I mean, the last several months have really been all about the strikes that we have seen. You've got the Hollywood strikes, you've got the UAW strikes, you've got hospital workers, healthcare employees also going on strike as well. I mean, what does that ultimately mean from a wage perspective when they have that leverage still? Partly, you could argue, because of a tighter labor market, to seek out higher wages and benefits.
Well, I think, again, that's a huge issue for the Fed. That's difficult for them to control. When the laborers have the upper hand and they're saying we want higher wages, companies really don't have much choice. And indeed, our own survey of CEOs say that they plan to continue to raise wages anywhere from 3 to 5% over the next year. So that's going to lean against higher interest rates. And certainly we think that means the Fed, even if they're done hiking for now, that they're going to leave rates elevated for longer, and that the easing that may happen, it's going to be minimal. And then the ultimate Fed funds rate is going to be higher going forward than what we've seen over the last 15 years.
Joe, just to briefly follow on the strike theme here, I mean, employment in manufacturing decreased by 35,000 in October, reflecting a decline of 33,000 in motor vehicles and parts, largely due to the strike activity. All of this considered, when you think about how we now have to kind of calibrate future reports for where some of those jobs are going to come back, where ultimately the strikes and that consideration is in future reports as well, what is that? How do we kind of readjust our calculus around this, if necessary?
Okay, that's going to reverse next month, right? And we can see what's going on in manufacturing construction. That means we're going to be opening new factories. You can see them along Highway 290 in Texas from Austin to Houston. These manufacturing plants are going to be making semiconductor chips, which we're going to sell across the economy and all over the world. Look, I'm a consumer and I'm looking at this report. You know what I see? 4.1% increase in average hourly earnings. That's above inflation. You know what that means? Positive income growth. We got a GDP that grew at 4.9% in the third quarter of the year. Over the last 2 quarters, we've had absolutely robust increases in productivity. You know what that means? Margins are going to increase. Guys, I got to tell you, there's just too much gloom and doom here on Wall Street. What's good is bad. No, that's not how the public's going to see it. And I don't think that's how policymakers are going to see it either. This is a good report. People are getting jobs. They're making more money. Employment remains very easy. The fact that if you lose a job, you can get a new one within 2 months. That's an extraordinary statement. And look, the demographically induced changes that are happening in the country are going to guarantee that we're just going to have a tight labor market indefinitely. I think 4% is our new full employment. And anybody who expects the dynamics of the past 20 or 30 or even 40 years in the labor market to return, you need to take another look at what's going on in the data, and you need to take a look at what's going on in the country. This is good news, and we should celebrate it. Let it celebrate it. Like I said earlier, too easily we fall into that false choice or false dichotomy of recession versus soft landing. This is really solid business expansion, and we ought to note it as it is.
But Joe, where does that ultimately leave the Fed? If we need to come to accept here that the labor market's going to remain strong, right? I mean, Dana pointed to higher wages. I mean, employees still have more leverage. I mean, that's still inflationary. So what are the levers the Fed pulls if, in fact, this jobs market is here to stay?
All right, if I take a random walk off Wall Street, make a right and go over the New York Fed, you know what I'm going to tell them? Our star, the neutral rate, is higher. We're going to have a much faster economy that can grow at a much lower inflation rate. We're going to have rates that are going to be higher for longer. I think the policy rate, look, we're not going back to zero. We're going to settle in between 3 and 3.5. You know what that means for the 10-year yield? 4.5 to 5%. If you're wondering about, wow, what's that going to do to the mortgage market? Well, mortgages are going to remain high or very expensive for a while, but I think they're going to drift back down in that 5.5, 6% region. That's going to be your post-pandemic era economy. We all need to begin to think about those shocks, the long-lasting changes, and what it means for policy. We're not going back to zero. That era of massive leverage is not coming back.
So, Joe, you're sort of arguing that what we have today is what we need to accept, that this isn't all
That's
doom
right.
and gloom, but it's also not going to change. It's a shift in sentiment.
Well, it's not. It's a shift in structure, more importantly, right? It's just that we're all going to have to learn to manage through and around the new realities of the economy, which is higher for longer, a quicker pace of inflation, which means higher interest rates. I think ultimately the Fed will lift their inflation target from 2% to 2.5 to 3% to acknowledge this reality, but well after the point in which it's already become accepted.
Dana, in the most recent consumer confidence figures, you also mentioned that more than 2/3 of consumers still said recession is somewhat or very likely. Does this report signal anything or show any signs of recession?
Well, I think the answer is probably no, right? Because labor markets react after GDP. So if you have GDP going negative in the first half of next year, then you'll start to see the labor market and payrolls go negative as well, right? You have to look at the timing. But I mean, I have to say that our outlook for the U.S. economy is actually slower growth closer to potential, and inflation. If the Fed wants to keep inflation at 2%, and I don't think they're going to change the target because that would impact their reliability and certainly whether or not people trust what they have to say, then that means that they will have to keep interest rates higher. The bigger issue is still inflation. Inflation impacts everybody. And in our consumer confidence survey, most people were still complaining about higher prices for food, for energy, for prices in general. And so the Fed still needs to address this. And I don't think that we're going to see these outsized growth rates. Indeed, if you look back at the third quarter, you had some special factors that bolstered GDP. They're not going to be repeated in subsequent quarters. And consumers are complaining about incomes being slower, their personal finances not being as strong in the future. We can't ignore that and just look in the past and say, well, you know, everything was awesome earlier this year, but not look to the future.
Dana Peterson, the Conference Board Chief Economist, and Joe Brusuelas, RSM Chief Economist, joining us here to break down all things jobs. Thank you so much for helping us dive into this employment situation report. We appreciate it.
Thank you.
Thank you.
Thanks. Let's do a quick recap of the numbers that we got out this morning for the October jobs report. Non-farm payrolls came in at 150,000. That is below the expected 180,000. Unemployment above the expected 3.8%. It came in at 3.9%. And average hourly wages just slightly above the expectation there. Came in at 4.1%. We've got more coverage ahead for you at 9 a.m. You're watching Yahoo Finance.
Welcome back to Yahoo Finance. We are continuing to dive into that jobs number today. So payrolls growth slowed in October, but we just heard from RSM's Joe Brusuelas calling it another rock-solid jobs report. The unemployment rate had been seen as a more accurate signal this month because of the impact of the worker strikes. That number ticked higher to 3.9%. So what does this all tell us amid the recession versus soft landing debate? Let's bring in Jordan Jackson, JP Morgan Asset Management global market strategist. Good to talk to you this morning. We just heard from Joe Brusuelas, who said essentially, look, the job market is here to stay. accept it, deal with it? This is the new reality. How do you view this?
Well, I view today's report as firm, but still evidence that the labor market is gradually beginning to slow here. I think when I listened to Chairman Powell's comments, one of the things he emphasized was that they want to see a trend in the data, right? And once is a coincidence, two is a pattern, three is a trend. So they're looking at this 3-month moving average in payrolls, and it has continued to trend lower over the course of this year. And I think this reaffirms that they feel confident that they've gone on pause for an extended period of time, but that they're going to stay higher for longer, right? Because we're still an economy that's adding jobs. The big risk here, though, when you have growth that's as strong as it is, running above potential, and you have a labor market that is more or less at full employment, historically you get inflation. And so that's why I think they probably want to keep rates higher for longer. The wage number, when you look at the CPI, when you look at ECI, when you look at the Atlanta Fed wage growth tracker, wages have kind of remained pretty sticky at north of 4%. And that dynamic hasn't really changed. I think that comes a little bit on the supply side challenges that we're seeing. But all in all, I think this was still a firm report, reinforces kind of that soft landing Goldilocks scenario. Markets are rallying, bond yields are coming down. This is kind of what the Fed was hoping for.
Markets rallying just because this looks like, okay, this is for a Fed that's finally acknowledged higher for longer, perhaps some type of light at the end of the tunnel.
Well, at least no more rate hikes at the end of the tunnel. Now, Chairman Powell also emphasized that the committee's not even talking about rate cuts, right? And I think that was really interesting. So we have to balance that. They're balancing the two-sided risks, as they also highlighted. And I think this keeps them higher for longer, well through the first half of 2024, before they start to gradually reduce interest rates.
Does this quiet that debate, by the way, Jordan? You know, it feels like we've been talking about recession versus soft landing for some time. I mean, you could argue the landing's already happened, or it is happening. Where does that put you in that debate?
We're still in that soft landing debate. I think we could be an economy that continues to gradually add jobs. Maybe we fall the first half of the year to below 100,000 job growth run rate over the first half of 2024. That will put modest upward pressure on the unemployment rate. But we don't think even in a soft landing or even a soft recession environment that we're talking about 5-6% unemployment. I mean, because of the lack of labor supply and still the strong demand for labor in sectors like healthcare, we think the peak unemployment rate is going to be relatively limited over the course of next year. So we're still in the soft landing camp. We think this is an economy that can continue to gradually add jobs. The momentum will continue to slow from here. And I think this, again, keeps the Fed, this firm that the Fed is probably done here.
If we never have to say the word soft landing again in the future, Jordan, I will not be upset. I had enough turbulence on my flight back from Ohio last week. Always want to have a soft and good, smooth landing. But for an investor that's waking up this morning, putting on their slippers, firing up the Keurig machine or whatever coffee maker they've got, and thinking about if there's a trade that they need to initiate off of this report, their portfolio positioning, how should that be rethought, if at all, following this employment report and situation?
Sure. Well, I think in the bond market, this maybe allows you to start to leg back into duration. Investors have embraced the very, very short end of the curve. I still think with the Fed on pause, you can still stay a bit short duration, lock in those juicy yields. The curve is still inverted, i.e. short rates are still higher than long-term interest rates. But I think this allows you the opportunity to gradually start to leg back into duration. You think about the 10-year down 30 basis points or so, maybe a little bit more since the start of the month. Right, that's been some pretty nice price appreciation, right, that we highlight at the outset of the call. And if the growth continues to moderate and we are potentially seeing an environment of sub-trend growth, that should lead to lower levels of inflation. And the Fed will also, again, start to reduce rates probably sometime in the back half of 2024. That suggests that maybe rates have a bottom, but we're probably far from the bottom from here. I think the 10-year can probably fall to somewhere around 3.5% over the course of next year. And again, that's some pretty nice capital appreciation. On the equity side, I still think valuations are very, very important. We actually still like tech. These are good businesses, strong business models, cash flow generating businesses. But the valuations still sort of concern us again in a potential higher for longer interest rate environment. So we're being selective in those sectors, but in an economy that may slow, you want to embrace companies that still have a bit of pricing power, where inflation is kind of coming down. As a consumer, inflation's your foe. As a business, inflation's your friend. And so as we think about this downward trending inflation narrative, it's still looking at companies that exert a little bit of pricing power in this environment.
Jordan, going back to bond yields, you mentioned that we could see a bottom there. I mean, what about the peak? We're at 4.5% on the 4.5% on the 10-year. We're sort of flirting with that 5% level. Is that still in play as you see it, at least in the short term?
I think in the short term, we can't rule out another move higher in long-term interest rates, right? The technical factors, increased bond supply, the demand for bonds moving from insensitive buyers to price-sensitive buyers. You no longer have the Fed, commercial banks, foreign investors piling money into the Treasury market. So maybe those technical factors could continue to play out over the very, very near term. But historically, you tend to see long-term interest rates peak out around the last Fed rate hike. Now, if we've had the last Fed rate hike, we've now had 2 consecutive pauses, and to me, that suggests that the Fed is willing to proceed carefully and remain very, very cautious from here. I do think that I'm still biased towards interest rates over the next 12 months to be lower than where they are today. But again, if the Fed's going to stay higher for longer, the curve can remain inverted. And so that's why this is this kind of sweet opportunity, I think, over the next 3 months for investors to kind of begin legging into duration. Hopefully we're probably going to get some stabilization at best for long-term interest rates now that the Fed is finally done. But I think over, again, the next kind of 6 to 12 months, long-term interest rates are probably going to be lower than where they are today.
Yeah, some interesting takeaways there. Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Good to talk to you this morning. Happy Friday. Appreciate
Happy Friday. Thank you.
Let's do a quick recap of the jobs number that we got out this morning. The headline number coming through at 150,000 jobs there. That was weaker than expected. Taking a look at the unemployment rate, it did tick slightly higher from 3.8 to 3.9%. One thing worth highlighting here, the UAW strike impact, one that we were watching really closely. Employment in manufacturing decreased by 35,000 in October. The BLS saying that reflected a decline of 33,000 in motor vehicles and parts, largely due to strike activity. We've got more coverage ahead for you coming up on the other side of the break. You are watching Yahoo Finance.
It's 9 a.m. live from the NASDAQ market site in New York City. I'm Brad Smith alongside Akiko Fujita. This is Yahoo Finance Live. Here is your morning rundown. A slowdown in the October jobs report. Payrolls came in cooler than expected as unemployment ticked up slightly. A welcome change of the pace for the Fed after September's red-hot report blew past expectations.
And the verdict is in. The jury finds former crypto billionaire Sam Bankman-Fried guilty for his role in the collapse of crypto exchange FTX. The 31-year-old faces more than 100 years in prison. His sentencing is set for March. The trial closely watched by investors for signs of a larger crackdown on the mostly unregulated crypto market.
And the jam-packed earnings week that was. Apple's iPhone sales were stronger than expected, but the company still sees a slower quarter ahead as under-pressure consumers cut back on bigger items. Smaller purchases still seeing strength, though. Folks in the U.S. continue to splurge on their morning Starbucks latte. And as consumers trade down on dining out, McDonald's expects to win big.
The payrolls report coming in at 150,000 jobs added in October. That's below estimates. Economists were looking for 180,000 after September's blowout report. The big question, would strike action in the U.S. distort the number? The BLS said around 30,000 UAW workers were off the job at the time it conducted its survey last month.
The unemployment rate had been seen as even more important this month in that context. It ticked up to 3.9%. Finally, that all-important reading on wage growth that came in at 4.1% on the year. All this as the Fed's pause continues to capture markets' attention here. And we've finally heard the Fed acknowledge here this week during their press conference and their decision that higher for longer is certainly a reality that they are considering, and how they are navigating it is still continuing to be data dependent. But when you get data like this, at least the markets react positively because they say, okay, maybe there's some easing to how much the Fed would need to hike from here, if at all, and where does a cut start to get considered? Yeah,
and we've been tracking the market reaction closely on the back of what was a weaker than expected number, but still showing strength in the market here. Dow futures up 650 points right now. S&P futures up 21, and the NASDAQ up 51 there. Brad, you know, I keep going back to Joe Brusuela's comments from RSM because I think that he sort of crystallizes what we're trying to wrap our head around, which is this is not a bad thing just because it came in lower. 150,000 jobs still added. And his main point being that we need to stop expecting a dramatic slowdown in the market. This is a strong labor market. It's here to stay. And the Fed's got to work around it. Yeah.
And we got revisions, too, that also for August and September, both of those months were actually revised down. August was revised down by about 62,000 and ultimately came in at about 165,000 there. So that was the revision. September, that final revision puts it at actually 297 compared to that 336,000. That would have been and was a red-hot reading, as Joe Brusuelas was describing this as a red-hot or even a rock star type of report. Even with all of that in mind, you got to imagine from this point going forward where some of the strength that we've seen in the negotiations that have taken place and how that was acknowledged within this report. For anybody who was wondering, and that was the big question mark, how would it show up in the data? We got that answer here today as the strikes that took place at some of the big three automakers here in the U.S. certainly made known in this report as well.
Yeah, and the UAW is certainly in focus, just given the impact of the big three. But really, we have seen this labor discussion continue, right? I mean, that seems to point to the strength that workers still feel they have, the leverage they have. That could be inflationary moving forward. Right. We've seen the wage growth already, but we're talking about, even if you just look at the results of what actually came out of the UAW strike, the UAW got a significant portion of what they wanted. And so, you know, I am curious to see how the labor story, as in the union story, continues to play out in the overall labor market, because we have seen this, the summer of labor strikes sort of trickle in to fall as well.
Well, there's one more strike, of course, that is still going to need to be netted out, and that is in the actors front, too. So as we continue to watch all this going forward, this is the latest on the employment situation as of right now. But we got to switch gears here and talk Sam Bankman-Fried, who has been found guilty of all 7 charges he was facing, including wire fraud, securities fraud, and money laundering. Here now with the details is our own Alexis Keenan. Hey, Alexis.
Good morning. Yeah, it was a very somber and tense in that courtroom last night. The jury deliberating for just under, I would say, 4 hours. So this was an incredibly swift verdict, finding Bankman-Fried guilty on all 7 charges brought by the Justice Department. Those charges: wire fraud conspiracy, as well as securities fraud and commodities fraud and money laundering. Together, when you add up all of these charges, they have consequences of 110 years in prison. Bankman-Fried will likely be sentenced to far less than that, a fraction of that, but nonetheless could result in decades behind bars. He is also facing another set of criminal charges that the government has to decide by February whether they will actually bring those charges. They're related to bank fraud and also campaign finance donations that the government says are illegal. Now, the jury heard evidence about what Bankman-Fried told investors, lenders, customers about the deposits on FTX's exchange versus what he actually did with the money. We now know that his hedge fund, Alameda Research, was using that money, leveraging it, spending it on real estate, on political donations, and other expenditures, other investment, large multi-billion-dollar investments, using that money. And they did not believe Bankman-Fried's testimony when he got up, took the stand, and in his own words said as CEO that he did not know that Alameda had accrued a whole of $10 to $14 billion using those customer assets. So the jury not buying his own words there. But guys, Bankman-Fried has potentially a long road ahead. He may still be facing other charges.
Alexis, I wonder if you can put this in context for us, because I know you've covered a lot of legal cases. White-collar crime, specifically, we were talking about this during Elizabeth Holmes as well, don't always see it prosecuted with sort of the way in which this was, right? I mean,
Sure.
we're talking about a big scale, sort of now, he's been charged with fraud here, but can you speak to how significant this is in the context of past cases that we have seen?
Sure.
4-week trial, 4 hours of deliberation, 110 years potentially.
Yeah, so I think, most recently I covered the Elizabeth Holmes case, and she was facing 144 years in prison. That case, though, took 6-7 years to bring her to justice. But definitely the Justice Department is interested in cases that have a lot of media attention, like this one, right? Because it can send a message about this type of behavior. And so certainly with so much debate still about whether cryptocurrencies are commodities, whether they're securities, and we saw a mix of that in this case, with that being unsettled, the Justice Department does want to send a message that this kind of behavior is not going to be tolerated. Of course, on the securities side, there are regulations in place, reporting in place that can protect assets when it comes to investors. But on the commodities side, in terms of Bitcoin, which seems to be somewhat settled, that's a different story because the laws do not require as much reporting. So customers are a bit more vulnerable there. So certainly this case would be exemplary for the Justice Department and is certainly meant to send a message.
And Sam Bankman-Fried set to be sentenced in March. We should point out, by the way,
March
his
28th.
inner circle, right? Closest inner circle also still need to be sentenced. We're talking about his former girlfriend, Caroline Ellison, who led Alameda among that group. That's expected to take what, next year?
Yes, so 3 top executives will be sentenced next year. And the reason that is put off is because the government has entered deals with them for their testimony, for their cooperation during the year that they put together this case, through their testimony at trial. The government wants to make sure that they got up on that stand, told the truth, and lived up to their promises before they're going to get their sentences, because all of that behavior will be considered when it's time for them to stand up in front of a judge and receive their consequences for the actions that they pled guilty to.
Okay. Alexis Keenan, appreciate your reporting throughout the 4-week trial.
Of course.
Thanks so much. Well, Bitcoin hovering just over $34,000 this morning, just off of its recent highs. The volatility in the cryptocurrency is putting a dent in the exchanges that hold it. Coinbase saw trading volume sink in its third quarter amid volatile trading sessions for the cryptocurrency. Meanwhile, MicroStrategy had to write down more than $33 million in its most recent quarter thanks to the falling coin price since its November 2021 peak. Our next guest has remained a Bitcoin bull despite the fluctuating price and scandals in the crypto sector, like Sam Bankman-Fried's recent fraud conviction. Let's bring in Bill Miller IV, Miller Value Partners Portfolio Manager. Bill, good to talk to you today. Let me get your reaction, first of all, to the verdict that was handed down, what this ultimately means for crypto as a whole.
Well, I think it's really important that we differentiate between Bitcoin and crypto. So crypto was convicted yesterday on 7 counts of fraud. Lying to people about what you're doing with their money is wrong. The beauty of Bitcoin is that's not an issue. There is a very clear digital ledger maintained by computers and a very clear protocol out there that's visible for everyone to see. Bitcoin is very different from crypto. So crypto was convicted yesterday. Bitcoin is still going very, very strong. The network's as strong as it's ever been. You know, there's more users than there's ever been. So we continue to see very positive trends in Bitcoin, not so much in crypto.
What is the most positive trend? And do you believe that it's largely, especially with some of the price action that we've seen recently, that seems to have been driven not so much by what's taking place in trials, but more so by some of the ETFs that could be set for approval?
Yeah, I think the big picture trend is that Bitcoin is the best performing asset in 9 of the past 12 years. It goes up, it's been up 3 out of 4 years. People tend to focus on the very short-term fluctuations and the volatility. But the reality is there's a real demand globally for an uncensorable asset where the regulators can't change the rules and the measuring stick over time. So I think another thing that's driven Bitcoin's appreciation recently is the massive debts we're racking up in the U.S. Deficits are going up, debts are going up, and someone's going to have to pay for that ultimately, and it's going to come from money printing.
So what's the next lever for Bitcoin, you think? I mean, are we really going to get back to the highs that we saw in 2021?
I think next year, the halving, if you look at historical patterns, to the extent they hold again next year, the halving means a reduction in the marginal supply of Bitcoin. If the demand does not change and the marginal supply effectively gets cut in half next April, there's only one clearing mechanism for that. It's higher price. So, you know, there's all kinds of positive trends. The fact that fiat currencies have an almost perfect track record of failing over long periods of time. Bitcoin's much harder for people in the US to understand, given that we have a clear rule of law and very clear processes to expand the money supply. But the reality is, the money will be printed. Bitcoin supply is very clearly laid out, and that's a huge benefit for Bitcoin holders.
Bitcoin's found some of its biggest success in crypto as a whole, some of its biggest success when FOMO is high. When there is lack of FOMO or lack of risk that people are willing to take on in their portfolios, you know, what should we make of how crypto is set to perform at that point in time? And then even further forward, if they say, okay, this is just too risky of an asset, regardless of what types of other assets are layered on top of one particular vehicle?
I think it's important to define risk. A lot of people equate risk and volatility. The reality is you can't have an asset that's gone up by as much as Bitcoin has over the past decade without volatility. And that goes both ways. And so that's hard for a lot of people to tolerate. But the reality is people that have tolerated it have done very, very well. And so I think that's an important thing to think about. And the way you frame it is interesting, because is it really Bitcoin that's volatile, or is it people's perception of this new technology relative to fiat currencies that are volatile? Fiat currencies are the real thing that's volatile. There's only 21 million Bitcoin that will ever be created. And so yes, there's a lot of FOMO and trading in and out, and people should be looking at the bigger trend, which is that things move much, much higher. Best performing asset over the past decade by a gajillion %. But people focus on the short-term fluctuations in the here and now because they have short time horizons. But people that have longer time horizons, again, I think will continue to do very well in Bitcoin.
Well, I guess I mentioned risk in that the biggest risk coming to this point had been whether or not there would be actual wide-scale critical mass adoption utilization, whether there would be governments that would take a more crackdown type of measure versus an acceptance measure. And in some parts of the world we have seen that, but here in the US it seems like we're taking steps towards there being a way forward for holding cryptocurrency assets, but then it still comes back to the, okay, does there need to be utilization? And I kind of put that to you. Does that kind of quell some of the concerns around risk?
Ultimately, I think utilization for Bitcoin will occur, maybe on another layer on the Lightning Network. But the reality is, if you think about the fundamental aspects of currency, right? Well, you actually want you want the rules to be clearly set. The problem with all of these other currencies is the rules change every single year. And that's why inflation occurs and people's purchasing power goes down unless they do something productive with those assets. The great news about Bitcoin is that its value is derived solely from the amount of people that understand the technology and believe in it and buy into it. And so, we've seen a trend of that going up over time, over many years. The Fed has actually studied how much they think you could regulate Bitcoin. And what the conclusion they arrived at was it's very hard to regulate because it's simply a protocol on your phone. Now, of course, you have these centralized on-ramps like Coinbase and others. But the reality is that people wanted to push the button, it'd be very hard to do. And if you look at the history of regulation around Bitcoin in other countries, every time countries try and regulate it, search history goes up, usage goes up. So it's very hard to censor.
All right, we're going to continue to watch BTC very closely here in the near term. We know you will be as well. Bill Miller IV, Miller Value Partners Portfolio Manager. Thanks for joining us this morning.
Thanks for having me. I appreciate it.
Certainly. Concerns are not easing up for Apple. The health of the China market is a pressing issue for the company. China's contribution to Apple's total revenue just hit its lowest point in nearly 3 years. On top of that, sales of the new iPhone don't seem to be off to a raging start, and the company is expecting overall revenue to be basically flat for the current quarter ending in December. So what comes next for the world's most valuable company? Let's bring in Martin Yang, who is the Oppenheimer Senior Analyst of Emerging Technologies and Services, to discuss. Martin, just kind of broad strokes here. I want to get your read on the quarter and if some of this was to be expected considering the consumer environment that we're navigating through right now.
Of course. I think the September-December quarter, especially regarding iPhone performance and guidance, Apple delivered better than expected results relative to our prior concern of iPhone losing share to Huawei in China. After we adjust for foreign currency headwinds, China actually grew at a higher rate on a year-over-year basis versus North America. And this is despite very difficult macro situation. And the same for December, when we adjust for a 7% revenue impact from one more week of sales the year ago quarter, and iPhone, with or without that, is still growing, and that's a very respectable performance.
You mentioned the Huawei question here, that being that we have seen Huawei come back with a phone that you could argue some are more impressed with in terms of where their chip development is right now. What is that threat? Is it about consumers going for the domestic homegrown player instead of Apple? Is it about, Huawei's technology? I mean, is it even a threat for Apple?
Yeah, I think it's more about consumer cheering for local brands as opposed to a technology edge. Huawei, the Mate 60 series of family, they have a three-year-old chip relative to Apple's latest, A17 Pro. And on performance-wise, Huawei's high-end phone doesn't compare to iPhone's latest.
Right. Okay. So all of this considered, we're taking a look at shares of Apple here this morning. Pre-market down by about 2%. What are investors not liking? I mean, you said that this was, in some cases, better than expected. What are investors souring on right now?
Sure. So when we're looking at December guidance, the company is guiding flat year over year versus consensus, which is expected to be up 5% year over year. I think there has to be some math to be done to really break down, how many analysts are really factoring that 7% advantage a year ago with one more week of sales. I think, we expect to see the stock trading higher throughout the day as more investors realized beyond headlines that Apple itself is in fact not losing share, and iPhone as a product has remained very solid even in China in a very tough macro environment.
Yeah, I mean, with that said, there is a debate about whether, in fact, these upgrade cycles are continuing to slow, whether they'll be drawn out more. You could argue the iPhone 15. Our own tech editor said if you have the 12 upgrade, but if you've got anything after that, it's just not worth the upgrade anymore. Is that kind of what investors need to accept, if they haven't already, that the iPhone is about incremental changes moving forward?
I think as an Apple investor, you should have accepted that iPhone comes and goes in cycles in between 2 to 4 years since a very long time ago. And we have had 3 years of very strong iPhone product cycles. I think the one thing that's a little different this time is that we're not seeing iPhone declining versus the past down cycles because they benefit from an ASP mix shift to the higher end models, as well as a very robust emerging market growth. So, comparing to past iPhone cycles, I think the trough of current cycles, or the cycle trough we're walking through, is going to see maybe no growth as opposed to declines, whereas service revenues also complements very well on a down cycle with higher margin revenues coming to Apple at a much stronger volume than before.
Martin Yang, Oppenheimer Senior Analyst of Emerging Technologies and Services. Good to talk to you today. Appreciate the time.
Thank you.
We've got just about 10 minutes left to go until the opening bell. Let's see what stocks are doing in pre-market trading. Jared Blickery back with us to break things down.
Akiko, what a week we have here. Some dovish Fed comments and also a report that came in this morning with respect to jobs that did not spook the market, and we are seeing another rally. Here's what we're looking at in the pre-market. Dow up about 190 points, but over the last 5 days, this is in the futures, up 3%. But you want to see something impressive, take a look at the NASDAQ. That's up 4.25%. And then the Russell 2000, which had been under a lot of pressure, flirting with multi-year lows only this week and last week, it is up 6%. So pretty strong risk-on rally here. And let me just show you what's happened within the sectors. 4 days so far this week, soon to be 5. But real estate and financials, both up 6%. That's interest rates talking there. We did get the yield curve getting a little bit less inverted. Then we have consumer discretionary, that's XLY, tech, communication services, all of those outperforming and up more than 5%. So pretty strong there. And let me just show you what's going on in the Dow. If you're looking for any red spots, you're not seeing it. At least I'm not. Merck about break even. But aside from that, look at that. Apple, Microsoft, both up 5.6%. Now that is going to change in the pre-market because guess what? Apple, after its earnings, down about 2.3%. Probably going to open up in the red there. But that is not a disaster. And let me show you what's going on in the NASDAQ. Not too much red there. If I sort by performance, we can see actually Apple is on the bottom row there, down 2.2%. But that's with bookings. We also have Intuit, Atlassian, that's down about 7%. Let me just take a look at our leaders board. Here's what we've seen this week. Regional banks, I was talking about the financial strength before. Regional banks, that is in the forefront, up 3.35%. Then we have Chinese stocks. Then we have Korean stocks. And I was looking at those as a bellwether for the U.S. tech trade. Solar, ARC, which is disruption, cannabis, all of this to say that even the fringier parts of the markets have seen some nice run-ups this week. And we can see that, for instance, in ARC. And we can see some of these issues like Shopify after earnings up 28.7%. Going to tackle it on after the open there. And then taking a look inside the energy market, that's one of these rare sectors where we're actually seeing a little bit of downside today. Exxon down 1/3% and Chevron off just a little bit less than that. And then just rounding out the banks, number one or number two sector this week, JP Morgan up 4.2%, 73 basis points in the pre-market. And here's what it's doing on a year-to-date basis, guys.
Wow. All right. Jared Blickery, stay with us for the bell. We've got much more to break down and even more heat maps, as hard as it is to believe. There are more up there, folks. We've got all your markets action ahead, live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance.
Let's take a look at some movers this morning, and one business battling off those higher rates. Online used car giant Carvana defying the economic headwinds to beat the street in the third quarter, reporting earnings of $148 million on revenue of $2.77 billion. Shares in Tempe, Arizona's finest, are up over 500% year to date. They started gaining traction after it became clear a debt restructuring would avoid default, at least for now. Number one, is it Tempe, Arizona's finest? And also,
I don't know who they're up
expectations so
against.
low, right? For Carvana. I mean,
Yes.
okay, let's talk about how much the stock is up.
Yeah, stock is up, what, 540% over the course of this year?
Yes.
And that's pulling back off of some of the highs. But, okay, excuse me, 530%.
530%. But let's talk about where it was before that.
I mean, we see
because
that.
of those concerns around debt. Yes, there is a restructuring story that's happening, but is this...
What's changed materially here? I mean, okay, 80,000, almost 81,000 retail units sold. That revenue came in at about $2.77 billion. They're saying it demonstrates continued progress, significant progress on the path to profitability. That should be enough to warn you that this company still is looking for a path to profitability right now.
Well, and that's the big question, right? When you look at a name like this, sure, they have tried to restructure some of those costs, bring things down, but the end of the day,
Yeah.
that path still has not been laid out very clearly in a company like Carvana. And this is a stock, by the way. I mean, we talk about it a lot because it is quite choppy.
Yeah. The most choppy.
So, it's up 15%, sure. I mean, the expectations were fairly low, but to me the question really is, okay, so now you've beat that, but what comes next, and how does this company materially change so that they don't go down that same path where it was before?
Yeah, I mean, look, a lot of hee-hee, ha-has aside here. I mean, the total gross profit per unit is really what investors need to be paying attention to here on a go-forward basis. For the model that they've been able to disrupt the auto industry with in the e-commerce side, nobody's going to take that away from them, but the sustainability of it is in question here, and that is really coming back to how much they're able to see on each vehicle that they sell. This was up 70% year over year. So that is a good thing. That's a record total non-GAAP gross profit per unit of about $6,396 here. Now, would you want it to be far more than that? Of course, but it's that continued improvement, and can they lock in that improvement, I think, is one of the larger questions here. They also cited the macroeconomic industry and environment continuing to be uncertain, looking towards the next quarter.
Well, and if you talk about vehicle sales, yeah, the higher rate environment certainly isn't helping.
Yeah. Precisely. Well, we are just seconds away from the opening bell here, taking a look at both the New York Stock Exchange and the activity that's surrounding Wall Street. OMF is ringing the opening bell there. Okay, there we got the shot of the NASDAQ too. A lot of funfetti here on this Friday for Starbucks ringing the opening bell. Oh my goodness. There you're seeing some green funfetti and the red aprons. Have you gotten your holiday cup yet? Anyway, that aside.
Funfetti, I like that.
Funfetti?
Yeah.
You don't just have a Friday where you just toss funfetti around in the LA office?
Like it's one of those weeks where we should do that at the end of
We
the show.
need funfetti for the end of this week here. We'll get some from downstairs, we'll round it up, sweep it up, and then just toss it up like LeBron James in a moment. I know you like him. Anyway, let's talk to Jared Blickery. He's standing by with much more green and red on his screen.
Like your funfetti ideas there, I mentioned that Apple looked like it was going to open up in the red, which it has done, down 2% after its earnings last night. But aside from that, not a lot of red spots on here. Fortinet down 21%. That's catching my eye. And Atlassian down 4.7%. But let's take a look at the sector action. Tech actually taking a downbeat along with energy. Apple being down. That's not surprisingly weighing on the tech sector there. But real estate and utilities, those two very interest rate sensitive sectors, those are in the green. And let me just take a look at the bond market here. We are seeing the 10-year down quite a bit from recent highs. It touched 5.0%, and now we are seeing it 4.52%. That is a 50 basis point move to the downside. Let me just show you what that looks like in candlesticks. That is a big drop, guys. But look, 4.5% would be a natural place for it to pause, so we'll have to see. But in the meantime, this is giving equity is definitely a tailwind, especially some of those longer duration stocks like the mega caps and like the growth stocks in the tech field. Now, if we're taking a look at some of the leaders, meme stocks, that ETF right there, meme is up 4%, followed by solar, IPOs, regional banks, ARK Invest, that's disruption, gambling, China, and home builders. To the downside, crypto taking a little bit of a backseat, but I was just looking at this. Let me show you. Over the last 3 months, crypto, one of the few green spots, so maybe an uncorrelated asset hedge. We'll have to see how that fans out. But let me put this back on an intraday basis, and we're going to go through some more heat maps. Brad, we got so many heat maps here.
So many.
Semiconductors, looking at microchip, that's up 4% just behind me here. But other than that, just a lot of green, but not too much dark green. Here's software. I mentioned Atlassian. Looks like PanW down about 3% as well. But other than that, let's take a look at China real quick. Maybe got time for one or two more. Lots of green there. Pinduoduo up 3.5%, Alibaba up 2%. And here's where I wanted to go for maybe a little red. Yeah, too bad we had to end on this, but a little bit of red in the energy sector. Exxon down 0.9%, guys. Excuse me.
Okay, Jared Blickery, thanks so much for that. Well, let's talk about some other movers that we are watching. Sports betting operator DraftKings beating expectations with third quarter earnings. The business seeing 2.3 million average monthly players. That is ahead of expectations. The bigger picture here, DraftKings began life as a fantasy sports contest before expanding into the sports betting space. As sports books go, it's now become a serious player along with rivals Fanatics and FanDuel. The latter is still the market leader, though DraftKings has a 25% market share. Actually, we should update this, by the way, because DraftKings recently surpassed FanDuel as the market leader in the space. Revenue up 57%, right? We're still talking about loss per share of 60 cents, but the company really talking about the expansion into other markets. We're talking about Kentucky, additional launches planned in Maine and North Carolina. That has added to the user base coming in. There is a question here, though, as we continue to see the legalization of sports betting in individual states. What are the other big levers? Josh Schaefer and I were talking about this yesterday. California's still one that hasn't come in.
Yeah.
And as those states sort of stall out, right? Texas still another one that hasn't. What are the additional levers you can pull?
Right, you got to place your bets while you're here in New York with us. I mean,
I don't bet on my own teams, by the way.
No? Okay,
Yes.
all right.
I'm very superstitious that way.
I have bet once on my own team this year. But all these things considered, I think you hit the nail on the head with the customer acquisition costs that they have to take on every time they try to get into a new jurisdiction or get into a new state. And one of the call-outs that they did have within this report, they saw continued healthy customer engagement, efficient acquisition of new customers, and the expansion of the company's sportsbook product. But it's really that efficient acquisition of new customers that I think investors are going to want to track closely going forward from here, especially as they're trying to get into some of those new states, generate new partners as well here on the iGaming side. But I think for a lot of the sports bettors out there, it's really remarkable, the consumer environment right now. People are not going to buy electronics. They're not going to buy new apparel or footwear at the same rate that they were before or last year. They're not going to buy new home appliances, but they're willing to bet some dollars right now.
Well, because it doesn't cost a lot, right? I mean, that's the thing. You know well, Brad. You
Not
don't have
well.
to go all in
I'm not doing it
on
every
your
week,
life
folks.
savings. We're not talking about big ticket items here.
Yeah.
And it has really changed the way that sports is viewed. Yeah. Obviously, DraftKings has been able to take advantage of that really in a big way. It chip away at that market share.
Absolutely. Well, from sports betting to sports streaming. Fubo TV narrowing its loss in the third quarter as revenue jumps on an annual basis. Importantly, the subscriber count hitting a new high. Fubo also raised its full year 2023 guidance for North America. You're taking a look at shares right now. They are down by about 1.6%, we'll call it, for this company. And for sports streaming, I mean, there have been a lot of different plays to garner rights or even new series in Fubo right now, I think, for the number of fan bases out there that they have to attract. It's been a critical year for how new sports are charting for some of these new deals and agreements, and how the licensing, the broadcast partnerships are not just, okay, who's over linear, but it's also, do you have one different linear partner versus a streaming partner that you have? And that's where I think Fubo is able to generate a lot of this fanfare right now.
Yeah, in some ways, you know, you sort of wonder, well, okay, these the expansion, you could argue, in terms of the platforms that now offer live sports. What does that mean for Fubo? The CEO specifically saying that the company's aim is to be a super aggregator, so offering customers premium content delivered through, and as he describes it, a personalized streaming experience at the right price points. And that sort of points to how I think viewers really want to move forward, right? I mean,
Yeah.
we've talked so much about just how many streaming subscriptions you need, where the content is out there. If you can sort of play the aggregator in the middle of that, you would think that that's kind of a sweet spot.
Yeah, and I think for Fubo, they have the right idea within their approach of making sure that people know that if it's costing you so much now, and for all of the pricing wars and the pricing strategies that have moved forward, whether that be Disney raising their prices recently, whether that be Apple as well, all of these things considered, for all of the sports rights that have been going after people who already have one streaming provider or another, or one entity that, whether it's Hulu or Disney or the bundle that is now, or Netflix, they are realizing that they're paying more, and so are they going to decide, all right, I just want to pick one or two that I'm comfortable with paying with, and it might just be for sports, or it might just be for, say you like Home and Garden, maybe it's that, who knows?
Yeah, we've heard some guests who say specifically on sports that they think all the fragmentation in the market could actually strengthen the case for cable.
Right. Yeah. Well, all your market action ahead live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance. I just had flashbacks, so many flashbacks. If you want to slay and start trending with Gen Z, no cap, you have to listen closely to our next guest. His sneakers just moved up to number 4 among teens, surpassing Vans, according to a recent Piper Sandler survey. And their partnerships with athletes, as well as being a sponsor of this weekend's New York City Marathon, has boosted the company's profile. We've got Joe Preston, New Balance CEO, with us. Great to have you here in studio with us ahead of a very big weekend for you guys.
Well, good morning. It's great to be here. Yeah, it's always an exciting week leading up to New York City Marathon. You have 50,000 runners that come from around the world, literally 150 countries that they come in, and all of them been training for a big day, and it looks like the weather's going to cooperate.
We'd love to hear weather cooperation. Look, a big weekend in the midst of a big year for you guys. I mean, you think about some of the fanfare that you've got among the cohorts of millennials, Gen Z, Taylor Swift, Rich Paul, and then the performance athletic side too. It sounds like, and it looks like things are clicking on all cylinders. How do you capitalize on this moment and move the business forward from here?
Yeah, our business is really strong. So it's been that way for 3 consecutive years, and we just had our best back to school ever. All of our metrics are really strong. It's happening here in the U.S. We're about 1/3 of our businesses in North America, and the other 2/3 are around the globe, and every region is up over 20% versus the previous year.
What do you see as the big drivers, though? I mean, in some ways, when you think about where New Balance is, he's talked about the collaborations that you've had, but you know the athlete collaborations. You've also had collaborations with some big brands, too.
Yeah. Well, it's never just one thing, but the collaborations that we have done and continue to do, we're very selective about who we work with, but those have been a good accelerator for the brand. You know, the product that our teams are producing, the fit, the finish, the feel of all of them, it's really, you know, when people come into the brand and experience that, they usually come back.
What's the next leg of innovation look like for New Balance?
Well, you know, we have our teams that are constantly focusing on trying to make product, whether it's the midsole, more responsive, more cushioning, and all of that. And, you know, we just introduced the 1080, which I'm wearing today, which is the official shoe of the New York City Marathon, a couple of weeks ago, and it's been our strongest introduction of a running shoe in many years, so we're really excited about it.
You've got a good pulse on the consumer as well, at least where you compete in the market. I'm curious what you have seen in terms of where the spending is. You know, do you find that consumers are still willing to shell out sort of at a higher price point? Do you see a little pullback? No, we're talking specifically shoes, but I'm just curious what your vantage point looks like.
Well, for our brand, we have been gaining shares. So our business has been really strong. Overall, the footwear market for athletic footwear has been struggling here a little bit. It's been a difficult year for retailers in general. But you know, you're seeing young people that the expression that they want to have is usually a phone and what they're wearing, and footwear and apparel is a big part of that.
When you think about that difficult environment for retail on the whole this year, there's been a lot of kind of question mark about at what level has inventory moved through and into people's hands, on their feet, on their home, and at full price sales. How are you having to go about that pricing mechanism strategy at New Balance?
The entire industry dealt with sourcing challenges with the shutdown of overseas production, specifically in Vietnam, and that really impacted inventories. But now I would say coming into holiday, inventories are generally back to where they were before. I mean, some brands may have an issue just because some of the product isn't selling, but the sourcing challenges are behind us.
Yeah, sourcing challenges behind you, but to Brad's specific point on pricing, how are you seeing things shake down going into what is typically one of the busiest holiday shopping seasons? We've heard some retailers talk about additional discounting that may be needed because consumers are pulling back on discretionary spending. What's your expectation?
I think each retailer is going to deal with it on their own on how much they feel they need to discount. For us, you know, pricing power is really relative to brand strength. So right now we're enjoying a really strong brand, so our pricing power is as strong as it's ever been.
What's the hotspot outside of the U.S. for New Balance right now?
Europe is really strong. It's up over 30% this year, but all throughout Asia, every major market that we're doing business with.
Is there a specific trend or any type of activity that's driving that from what you're seeing in the sales of in those markets too?
I think during COVID really allowed us to become more of a global company. So the top sellers that we see here in the U.S. are the top sellers throughout the world.
You talk about sourcing and how you've sort of, kind of had to think about that over the course of the last several years, especially during the pandemic. Has that shifted where you think about manufacturing, when you think about sourcing, is the company really moving towards more diversification as we've seen with others?
Well, New Balance is the only athletic footwear manufacturer to have manufacturing here in the U.S. We have 5 factories here in the U.S., 3 in Maine and 2 in Massachusetts. We've also just finished building a manufacturing innovation center, which is 1 mile from our headquarters, which is going to allow us to continue to develop capabilities that allow us to grow our domestic production.
When you think about that manufacturing right now, we were just poring over the numbers earlier this morning, looking through the employment situation, and manufacturing, one of those areas that's been hit because of the strength of the employee right now in negotiations in the manufacturing sector. And it was autos in this case, but to what extent are you monitoring where there is the ability to make sure that the cost of living expenses that your employees face, that they're offset by making sure that they have not only a good work experience, but also a good compensation experience too?
Yeah, and there's many aspects to it. There's health,
right,
and benefits, and those type of things. You know, we've been in Maine for more than 40 years, and in the Merrimack Valley in Massachusetts for more than 40 years. So we have a really stable employment base there, and our HR teams are constantly looking at making sure that the wages are competitive and it's livable.
Have you seen them push higher? I mean, part of this is about the discussion with the employee and the expectations pushing higher as a result of where the labor market is right now.
I think everybody has experienced labor wages increasing over the past 3 years, regardless of the sector. So yes, we've experienced that.
We saw some amazing splits coming out of the Chicago Marathon just weeks ago. And so we have no doubt that there's going to be some remarkable display of athletic performance out here in New York City. Joe, thanks so much for taking some time here with us today.
Thank you. Appreciate it.
Absolutely. It's Joe Preston, CEO of New Balance, joining us here in studio at the NASDAQ market site.
Well, the payrolls report coming in at 150,000 jobs added in October. That's below estimates. Economists were looking for 180,000 after September's blowout jobs report. The big question, would strike action in the U.S. distort the numbers? The BLS said around 30,000 UAW workers were off the job at the time it conducted its survey last month. Now let's head over to Yahoo Finance's Jen Schomburger, who's standing by at the White House for us. Jen.
Hi, Kiko. For more reaction on this morning's jobs report, I want to bring in Acting Labor Secretary Julie Su. Secretary Su, thanks so much for joining me. It's always great to see you.
You too.
So we saw some weakening in this morning's jobs report. We also saw revisions downward of 101,000 for the prior 2 months. Is this a sign that the job market, the economy is starting to slow after a red hot summer, and that perhaps the Fed's rate hikes are starting to take effect?
Right, so this month's report shows 150,000 jobs added last month. That brings the total since President Biden came into office to 14 million. At the same time, we continue to see unemployment rates of less than 4%. To your point about the adjustments, even if you look at the 3-month adjusted jobs numbers, it's 204,000 per month. Now, recall that over a year ago, President Biden said that if we move from this current period where we were seeing 500,000 jobs a month to a number more like 150,000, it would signal that we were entering this phase of steady, stable, sustainable growth. That's exactly where we are and exactly where he wanted to be. And I think that's a sign that the president's economic policies, that Bidenomics is really working for American workers and also for the economy.
Do you think this level of job growth around 150,000 is sustainable as we go through this year into next year? And secondly, do you think this report actually would have been stronger had it not been for the UAW strike?
Right, so I don't want to make predictions about it, but I will say, again, the president's policies have defied expectations for a couple years now. People said that it would take a really long time to get to under 4% unemployment. We got there. And then they said there was no way to both control inflation and keep that unemployment rate down. We are also continuing to do that. So I think this is a good news report. Now, as to the UAW, and yes, because these were October numbers, it does reflect the strike that auto workers were on, and obviously that strike is now ended, and so we expect that those numbers will return. At the same time, it's worth noting that that strike and the bargaining that happened at the table have resulted in really historic gains in that industry in ways that demonstrate the power of unions and the importance of collective bargaining.
We saw the unemployment rate for Black women specifically spike to 5.3%, higher than the overall 3.9 number. What do you owe that to? How much do you think that can be chalked up to the child care supplemental expiring?
Yeah, so just to disconnect those two for a moment, we are always laser focused on equity, right? We want to make sure that we build an economy in which no one gets left behind. The president says all the time, this is a middle out, bottom out economy rather than top down. Is about making sure that everybody is included. So we have been focused on making sure that in the good jobs are being created across the economy because of historic investments, that every community has access to those jobs. I get to travel around the country to see programs that are specifically targeting communities of color, women, and in particular Black women for the construction jobs, for example. Now, the care issue, right, is also, we've saw a growth in the healthcare jobs, 58,000 added in the last month. That includes hospitals. It includes social assistance, which is a lot of care for the elderly. These are jobs that are going to continue to grow in our economy. The Bureau of Labor Statistics predicts that care jobs are going to be one of the fastest growing as we go forward, which makes sense. People are always going to need that. And so that's why the president has called for and called on Congress to make sure that there are investments in a child care infrastructure that can help support the rest of the nation's infrastructure.
We're seeing, as we've been talking about, cooling on both the top line as well as a little bit on the wage growth, though wage growth still strong. How much do you think we're starting to see this rebalancing in the labor market, something that Chair Powell has actually talked to, where you have more immigration, more workers coming off the sidelines? Do you expect this rebalancing to continue as we go through this year and into next year?
Yeah, I think this is about, the transition from what we saw in the last 2 years, right? We were coming out of a global pandemic. We were coming out of the pandemic-induced economic catastrophe. I do think that this is now the transition that the president predicted and that we wanted to see, which was to a rebalanced, steady, stable growth, not the red hot that people said was too hot. But I think, again, Bidenomics is showing that kind of growth allowed for people to come into the labor market, allowed people to achieve a level of stability, and now our focus is on good middle-class jobs being created in all communities.
This week, the Labor Department proposed a new fiduciary rule for a management of Americans' retirement, things surrounding rollovers of IRAs. It bears resemblance to a similar rule that was put forth under President Obama in 2016. That rule struck down by the courts. What gives you confidence this time around that it will be upheld and not see the same fate?
So we announced our retirement security rule. We welcome comments on it now, but the point is that for retirees, these are workers who save their entire careers in order to have security and dignity in retirement, right? Paycheck after paycheck, year after year, and those retirement savings should not be compromised by financial advisors who give advice that is not in the retiree's interests. That's what the rule is about. We obviously did it taking into account the court's decision on the prior rule, as well as input from industry. And so we are confident that we've struck the right balance here.
All right, switching gears slightly, you and I always talk about women and the economy. I had a conversation with Senator Cynthia Lummis yesterday about women's equal pay, and she told me that when unions are involved, there tends to be more parity between men's pay and women's pay. I know you've done work and research in this area. Why do you think that's the case, and can that be parlayed to other areas of the labor market? What can we learn from that?
Yes. So that's a great question, and it's an important point that the strength of this economy and the strength of unions are very much interconnected here. And that's why the president has said, right, he is going to be and has been the most pro-union, pro-worker president in history. And we're seeing that from his historic appearance at a picket line, right, supporting the United Auto Workers, but also policies that really give workers and unions more power at the bargaining table. And there's a whole lot of evidence that results in more gender equity. It results in more racial equity, right, that unions are good for lifting all communities up into good, stable jobs that provide them family-sustaining wages. So yes, and that's partly why we continue to pursue policies that are going to lift up workers, which, as the president says, benefits employers and all of the country.
Secretary Sue, thank you so much, as always, for your insights. So appreciate it.
So good to talk to you.
We'll see you next month. Thanks.
Thank you.
And that's Acting Labor Secretary Julie Su. We will be right back after this.
Welcome back. The nation's largest crypto exchange, Coinbase, posted its 7th consecutive quarterly loss, but one which narrowed trading volumes. The loss, which narrowed trading volumes, though, and the number of people trading on its platform, that fell. The business is, of course, currently mired in a battle with the SEC. It was sued by the exchange in June for allegedly operating an unlicensed crypto securities exchange, broker, and clearing agency. Not good. Importantly, this is the closest that Coinbase has come to a positive earnings result since the fourth quarter of 2021, when a crypto boom was still raging. Shares, they were lower earlier. Now they're higher by about 1.8%.
Yeah, I think that this is sort of, if we can dovetail it to what we were talking about with SBF earlier, it feels like that overhang. The concerns around that FTX collapse, what that could mean for crypto, that has started to clear a bit, right? We're talking about Coinbase specifically, but Square yesterday, which is Block, I need to always correct myself there, reporting yesterday as well. Their revenue grew 24%. Bitcoin revenue made up about 43% of the total revenue. So we are starting to see sort of this bounce back, if you will, certainly not at the highs. You're talking about Bitcoin specifically that we saw in 2021, but obviously, a company like Coinbase, where crypto is at the core, that's going to be a positive as well. The next lever you'd imagine is just really the spot Bitcoin ETF. The CFO yesterday saying on Bloomberg, at least, that he thinks there's going to be a lot more capital coming to the market once that's established.
Yeah, huge thing to remember with Coinbase here, too. The price of BTC and particularly Bitcoin, which accounts for roughly half of the crypto market cap, that declined 12%, and the overall crypto market cap declined 9% quarter over quarter to about $1.1 trillion. So we are a far cry from when there was so much FOMO, just risk appetite for people who were getting into crypto, and now that we've seen either the fallout from algorithmic stablecoins or the fallout from FTX, there has just been a compounding that took place over 2022, created a dark cloud, and ultimately plunged us into an ice bath that was already a crypto ice age, as some of our guests had already defined it, and that trickles through to and transitions into the transaction revenue that a company such as Coinbase, in this case, incurs declines on or sees ultimately. But they did see this macro backdrop contributing to the global spot market trading volumes declining 24% during the quarter, or quarter over quarter.
Well, and then you've got Bitcoin bulls like those we had in the previous hour who say this shakedown was necessary. You separate Bitcoin from the rest of digital assets, crypto, and that's why we're starting to see the bounce back, because not all of them were great.
Not all of them.
Not all of them. But you see Bitcoin down about 1% at least today. All your markets action ahead live from the NASDAQ market site. Stay tuned. You are watching Yahoo Finance. Welcome to Yahoo Finance Live, or welcome back to Yahoo Finance Live. I'm Akiko Fujita alongside Brad Smith at the NASDAQ in New York. We are about 30 minutes into the trading day. Let's take a look at how things are shaping up on the back of the weaker than expected jobs report. The major averages are in the green after the October jobs report missed expectations. That number coming in at 150,000. Expectations were for 180,000. The unemployment rate rising to 3.9%.
Some individual stocks that we're watching here as well. Paramount shares, they are jumping, as Destiny's Child would say, after the company reported strong revenue and positive subscription trends in the third quarter. Revenue jumped by 38% year over year, and the company added 2.7 million new subscribers.
And shares of Block seeing a nice pop this morning. The company showing strong growth in both Cash App and Square revenue. Block also coming in with a strong forecast for 2024. Block's initial plan to repurchase $1 billion worth of shares also raised investor spirits. Jack Dorsey saying the buybacks would offset some dilution from share-based compensation to employees.
And because it's Friday, all of our trending tickers are in the green. The last one for you, Expedia. Expedia moving higher after a strong third quarter. The company beating expectations on the top and bottom line and touting resilient travel demand. Expedia also announced a massive $5 billion stock repurchase program.
Former crypto billionaire Sam Bankman-Fried has been found guilty for his role in the collapse of crypto exchange FTX. The 31-year-old facing now more than 100 years in prison. His sentencing is set for March. Joining us now is former federal prosecutor and partner at Bryan Cave Leighton, Paisner, Renato Mariotti. It's good to talk to you today. This was a swift verdict. I mean, we're talking just about 4 hours. Any real surprises coming out of this?
No, I have to say, it's really a testament to the Department of Justice, the SEC, CFTC, who threw a lot of resources at this case, indicted it very quickly, just weeks after the collapse of FTX, and tried this case very well. I mean, they streamlined the case, only 7 charges. You've probably seen more charges in other cases, and really tried the case as if it was a garden variety fraud not focusing on the unique aspects of the case or the fact that it was crypto. I think that was the right move, and you've got a swift verdict as a result.
Why was it so expedited?
Well, there was a lot of resources thrown at this. You know, I was on this network when the indictment was announced, and the United States Attorney thanked dozens and dozens of different attorneys working on the case, many of whom I had worked with when I was at the Justice Department. And frankly, I think this was the administration deciding to send a message to the crypto industry. They were going to, investigate this hard. They were going to prosecute him to the fullest extent of the law. And I actually think there may have been a political aspect to it. SBF had contributed to Democrats. Republicans were making something of that. They were, alleging that the administration was going to go easy on Bankman-Fried, and they made sure that that was not the case, and they were very effective in doing so.
You say the administration trying to set an example here with this particular case, but fraud certainly not limited to SBF and FTX. What happens to some of these other crypto cases? You look at something like, for example, Terraform and Do Kwon. I mean, does this sort of open things up for additional prosecution now that the FTX trial is behind us?
I do think that this is going to embolden the Southern District of New York to think that they can handle other crypto cases. I mean, they've already charged and got a conviction in the first ever crypto insider trading case. And my understanding is that the Justice Department is taking a look at that, the Binance matter, which of course currently is not a criminal case. It's currently a civil regulatory case where, for example, the CFTC and SEC have brought charges, but nothing would surprise me at this point. I really think that there is a desire, I think, emanating from Gary Gensler and others within the administration to send a message. They've done it on the regulatory side with the SEC and CFTC actions. And I think they are very, much going to be aggressive on the criminal side as well.
What is likely to come then of the others who were also involved but were not the figureheads that Sam Bankman-Fried were? Caroline Ellison, others who worked within FTX and knew what was going on, but in their own cases, sounds like they may have gotten some type of plea deal so that they would ultimately come forward and provide their testimony.
Yeah, when you're totally screwed and the evidence looks very bad, cooperating with the government becomes a very attractive option. For that, all of his associates there who cooperated, including Caroline Ellison, they did receive cooperation deals. They did take the stand. In fact, I think Caroline Ellison's testimony was very important at the trial. I mean, she talked essentially about how SBF degraded her own moral character, more or less, and sort of molded her into somebody willing to commit fraud. So I think she's going to get a reduced sentence. All of them will. It wouldn't surprise me if the cooperators received single-digit sentences in terms of years. In other words, under 10 years. But I would expect a much, much weightier sentence for Sam Bankman-Fried.
Renato, I'm curious, as a former federal prosecutor, as you look at what has played out over the course of these 4 weeks, and then the last year, really, this stunning fall from grace for Sam Bankman-Fried. Yes, we're talking about fraud on a big scale, but 7 criminal charges, potentially 110 years, a life sentence. Do you think that crime matches the punishment? You've seen other white-collar cases. How does this pale in comparison to that?
It's a great question. The dollar amount is astronomical here. Okay, so just from that aspect alone, Sam Bankman-Fried is one of the biggest fraudsters of our lifetimes. Okay, that's unquestionable. I think in terms of the type of conduct, it's fair to draw some distinctions, right? I mean, his lawyers perhaps will argue, he was not out there. I prosecuted people who were swindling senior citizens out of their life savings, out of their homes. People who were, swindling their own families. He's not somebody who is one-on-one swindling people in that way. But the sheer audaciousness of the fraud, the sheer extent of it is staggering, and the numbers are huge. I do expect him to spend decades in prison, at least 20, 25 years would not surprise me in this case. The judge clearly not a big fan of Sam Bankman-Fried. And the judge will have a lot of discretion here. We don't know exactly what the punishment is going to be yet. You've given a theoretical maximum. The minimum is 0. It's certainly going to be in the decades, whether it's 20 years, 25 years. But any of that is a big fall from grace for him. And I'll just say, Sam Bankman-Fried really feathered his own nest here in terms of, or kind of ultimately dug his own grave, because he had an audacious fraud. And then once he knew that he was under criminal investigation, he did everything wrong by defiantly speaking out, not exercising his right to remain silent, taking the witness stand at trial, lying on the witness stand. He did everything wrong, and I think he's going to pay the price of sentencing.
Former federal prosecutor Renato Mariotti, thank you so much for taking the time and providing some of your insights. We appreciate it.
Thank you.
Thanks. Well, sometimes you just can't have it your way. Restaurant brands taking a hit from disappointing same-store sales from Burger King. The burger chain has been trying to make a comeback in the U.S. after lagging its rivals for years. The biggest part of the turnaround plan was leaning into the Whopper and renovating its restaurants. There was one bright spot in the report, though. Fried chicken is still king. Popeyes was the only chain to beat expectations for same-store sales growth. You might remember Popeyes recently overtook KFC as the #2 chicken chain in the U.S. So chicken or burgers, where should the company focus its future? Let's bring in Gregory Frankfort, who is the Guggenheim Securities Senior Analyst, to discuss this. Let's start there. Where should they focus their future?
I think you make a great point on chicken. I mean, chicken has been the brightest spot for the restaurant industry. If you look at Restaurant Brands earnings, you see what's going on. Popeyes is only 11% of profitability in the quarter, but it's growing units 11% globally. The entire business is growing 4%. So they're clearly making a bet. They're clearly driving chicken. And as a category, it's clearly been the place to be.
I'm getting hungry just thinking about all these brands right now, I will say. But let's talk about the main drivers as you see it. What are the levers that you think they can pull?
Yeah, so they brought in a new chairman, Patrick Doyle, who used to be, if you remember, the CEO of Domino's Pizza, executed a big turnaround there. One of his lieutenants at Domino's, Tom Curtis, is turning around the Burger King U.S. business. And so they're putting $400 million of capital into Burger King U.S., into the 7,000 stores here, which I think is a commitment and an emphasis on trying to get that business in a better place. It has been the weak spot in Restaurant Brands' earnings and P&L, and it's clearly a focus for the company going forward.
And so as you think about where we've seen the chicken sandwich wars transpire over the years and continue to kind of hold some ground, it seems like there has been a bit of perhaps a new reignition of innovation. How do companies innovate or reiterate on top of what they had already put out there? Is there a clear answer? Have we heard a clear way forward from companies?
No, I think it's a good point. I think you're seeing strength actually in the private companies. You're seeing Chick-fil-A and Raising Cane's. I mean, they are putting up the strongest AUVs in the restaurant industry in the fast food space. But in terms of what's public, we saw results from Wingstop over the past week where they're putting up 15% same-store sales. You saw upside clearly in Popeyes. I think in terms of innovation, I think it's a lot of companies continuing to deliver a really good value to the customer, and you're seeing good value in chicken, and these companies are leaning in there.
Greg, when you think about where the consumer is today, we've talked a lot about, yes, they are still spending, but they're starting to sort of pull back in many ways. What kind of tailwind does this current economic environment provide to a name like Restaurant Brands?
Yeah, I think one of the things that we've been thinking about is just as you've seen an increase in interest rates, an increase in cap rates, you've seen consumers lean into lower ticket, affordable ways to get an experience, and restaurants provide that. And so restaurant spending has actually held in pretty well here the last couple months and couple quarters, and we would expect that to continue in the near term. So I think that's one area of the economy that it's actually not really slowing materially. Restaurants have held in, I think, okay.
Fast food is quick, it's economic in some cases, it's a value play for some consumers' wallets, but at the same time, who is making the best case for nutrition along the way as well?
Yeah, you've got a lot of upstarts, a lot of the recent initial public offerings that have happened in this space. I mean, you've seen Kava, you've seen Sweetgreen, and I think there's been a clear emphasis on healthy. But even from the larger chains, there's been a focus on upgrading the quality of items, reinvesting into what either portion size. And so I think that's clearly been a focus from McDonald's. It's clearly been a focus from Restaurant Brands International. And that's, I think, the way they're trying to attract consumers and make sure that they're not switching to some of these upstarts as they're being basically competitively forced into this dynamic.
So we're looking right now at some of the competitor names as well. But just broadly speaking, when you think about this space, who do you think is best positioned?
We've liked McDonald's a lot. McDonald's has put a lot of capital into their system over the past 5 years. They basically, if they have 14,000 restaurants in the U.S., they reinvested in around 12,000 of them over the last 5 years, anywhere from $400,000 to $750,000 per restaurant. In a lot of cases, ripping the restaurant to the ground and rebuilding it. And I think that when a customer drives down the street and they see a fresh new asset in the ground, that matters, and it matters to same-store sales on an extended basis. And I think that's driving a lot of their success the last couple of years.
Okay. Well, you got me thinking about Popeye's chicken sandwich.
I'm ready to go.
All right. Brad and I are ordering, Greg.
We're done. Bye, Greg. See you.
Gregory Frankfurt, Guggenheim Securities Senior Analyst. Good to talk to you today. Appreciate the time.
Likewise.
We've got all your markets action ahead live from the NASDAQ market site. Stay tuned. You are watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm Brooke DePalma. Starbucks unveiled an update to its reinvention plan. The coffee giant plans to implement a $3 billion efficiency program over the next 3 years, $2 billion of which will be saved outside of the store. Now, through this updated plan, the company expects long-term sales growth of 5% or greater, revenue growth of 10% or greater, and earnings per share growth of 15% or greater. Here to discuss that and so much more is Starbucks CFO, Rachel Ruggieri. Rachel, so great to see you in person. Thank you so much for being here.
Thank you. It's great to be here.
So first, sort of break down for us how exactly you plan to work with employees, producers, as well as others to meet that $3 billion goal, and how are you going to measure success of that?
So the $3 billion is broken really into two areas. The first area is in our stores. And we've already, this past year, seen great progress on our reinvention plan, which was all about creating a more sustainable, what I'd say, efficiency level in our stores. And that was through the investments we made in partners and training, as well as wages, as well as investments in new store equipment and enhancements. All of that helped support a more stable environment. Our turnover went down, stability increased, and it allowed us to better serve our customers. And that was evidenced in, we had very strong out-the-window times, as well as it led to margin expansion and earnings growth. As we look towards that $3 billion, $1 billion more will come out of what we call in the store, which is the store operating expense. And that's largely around further improvements in staffing and scheduling, making sure our partners have the hours they need, but more importantly, in the right day parts.
Right.
So if you go to the store in the morning and it's super busy, it might mean that that store needs, more labor. Labor overall, our hours are good on an overall basis, but by day part is where there's a lot of opportunity and meeting our partners' preferences in doing that. The remainder of the $2 billion is largely in cost of goods sold. So things like in ordering our inventory more efficiently, using automation for that helps support reductions in waste.
Right.
Using our scale to buy more value in our as we source our products, that will give us opportunity to reduce cost of goods sold. And how we'll measure all of this, the efficiencies, it allows us to continue to invest back in the business.
Right.
So for this year, we'll see maybe about $1 billion in efficiencies, and we're investing back nearly $1 billion. And that will allow us to use our sales leverage and things like strategic pricing, which includes mix, customization, attach, to drive progressive margin expansion in the future.
And let's talk about that consumer here in the U.S. We're seeing the return of student loan repayments. We're seeing higher interest rates. Are you seeing any pushback to these higher prices? And how concerned are you that there eventually will be a pushback?
There's definitely headwinds in the environment, but as it relates to Starbucks and our customers, we had another quarter of record demand globally. So our fall launch really resonated with customers across the globe, and it led to record level demand.
Do you plan to increase prices again in the near future?
We don't see pricing. Pricing will be in the more historical levels. Where we see a pricing opportunity is through an increase in how we customize our beverages, or how our customers customize beverages, how we drive attach. We had another quarter of record food attach. That helps drive a higher ticket, as well as being able to have more premium beverages.
Right.
So the combination of that, what we saw in this quarter was we had the highest average weekly sales we've ever had in our U.S. business, our largest business. And that was underpinned by growth both in traffic as well as a higher ticket.
Right.
And a good portion of that ticket, over 50%, came from greater mix, customization, and attach. So as we continue to drive digital capability, as we continue to innovate, and as we continue to offer channels of convenience, we believe that will help our momentum even in the year ahead.
And I do want to hit on your real estate portfolio. You have locations in California. You recently closed 7 stores in San Francisco. We're going to see a minimum wage increase to $20 in April. How do you plan to mitigate that cost, and could we see more store closures there?
I would take that in 2 ways. Of the store closures, that's part of our normal ongoing quarterly process that we have. We look at our stores across our globe and make decisions both financially and strategically regarding closures. So that's part of a normal closure process. We remain committed to our markets, committed to our businesses, but there will be an ongoing normal aspect of closures that we do every year. It's quite small in the scheme of things. As it relates to the California, the FAST Act and the wages, we're still evaluating that. But with the guidance we've given, we believe that the spectrum of risk is wide enough that it allows us to leverage our broad and diverse portfolio and balance levers to be able to fuel our growth.
And bringing it to China real quick, other competitors and other food chains tend to go there and approach it as a franchise operated model. You guys plan to stick to a company-owned model. Why does that make sense? And will you ever consider licensed or franchise stores in China?
Well, I would start with the fact that we always evaluate our ownership structures, and we'll always do that. But today, as it relates to China, we believe a company-operated model works best because it supports the level of growth that we know is possible. We see the opportunity in the overall market, and we can drive that opportunity better ourselves. So that's why we've chosen the company-operated route. We have a great omnichannel business, which allows us to serve more occasions and a more diverse customer base. That's new over the past couple of years. And you couple that with the incredible experience our partners create and the innovation we can create in very local, relevant product offerings, that allows us to be able to see quite a bit of opportunity in China, and we meet that through the business model and structure we have today.
And Rachel, just really quickly bringing it back here to the U.S., we can't stop hearing about the potential impact of weight loss drugs.
Yes.
Are you guys planning for any potential impact there?
What we see is that what we offer at Starbucks is choice. So we have a lot of different options in terms of, I, for example, order a quad espresso every day. Some people go for a more decadent beverage. Caramel Wall, I just learned about as an example. So we believe choice is a path for us, always has been and always will be. But as it relates to our business, we're seeing record demand. Right. So we aren't seeing an impact from, all of those different, I'd say, pressures that we're seeing otherwise in the market.
Rachel Jerry, always so great to see you.
Thank you.
Starbucks CFO, thank you so much for joining us.
Thank you.
All your markets, action ahead, live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance Live.
We are at the Chase Make Your Move Summit in Frisco, Texas. It's putting a spotlight on small businesses. Now, we have thousands of small business owners gathered here, and they're talking about everything, sharing their success stories to growth plans, but also talking about some of the challenges that they face today and how they're navigating this murky economic environment. So here to talk about that and more, we want to bring in Ben Walter. He's the CEO of Chase for Business. Ben, it's great to have you here. Thanks so much for taking the time.
Thank you for having me. It's great to be here.
So you have a great pulse on the state of small business right now. I know you're partnered with just about 6 million small businesses here nationwide across the country. When we talk about the sentiment, what you're hearing from small businesses at the summit today, what is that like? What is their outlook?
Incredibly optimistic. I mean, that's the good news. When you ask, how's your business going? They say, really well. and I want to expand, and I need to expand. What they tell us is there's a few challenges. So the first remains inflation. So I'm happy to see that the Fed is continuing to fight inflation. I know they've paused for a while, but it's important that we get that under control. Small businesses really need that. They don't have the same buying power as big businesses, so seeing that really come under control is important for them. And the second challenge they're having still is hiring. It's hard for them to recruit enough people to grow and expand their business. They're telling us they want to borrow, they're telling us they want to expand, but they need to find the people to be able to do it, and that's a real challenge.
Ben, that's very similar from my takeaways so far with the business owners that I've been speaking with. They're very resilient, and also they're confident, though, just in terms of their growth plans and where they want to see their business be in a couple years from now. When we talk about looking ahead to 2024, are you confident that this trend is going to stick?
I am. I think we're in a little bit of a mood session. You watch the news every day and all you hear is bad news about how this might be going terribly, this might go down, we might see this, we might see that. But actually, when you look at the real numbers, the economy's good. Consumer balance sheets are strong, small business balance sheets remain in better condition than they were before COVID. So we see strength across the board. Hiring is strong, unemployment is very low. So the actual economic condition is better than the mood of the economic condition. And I think we need that to prevail a little bit. So I'm confident it's going to keep going because the fundamentals are good.
Ben, when we talk about what's happening right now in the macro environment, the Fed, whether or not they are going to raise rates again, my colleague Brian Sozzi sat down with Jamie Dimon last night and asked him just about his sense and what he thinks should be done or needs to be done in order maybe to cool inflation. It was interesting. He said that the Fed was right to keep on hold yesterday, but when we talk about what it's necessary going forward, he said he wouldn't be surprised if we do see more rate hikes. My question to you is, what would that then mean for small business owners?
I think it's a false front, really. I wouldn't focus on rates and where they go. And the reason I always say that is, look, if the Fed is, everybody says, I hope the Fed starts cutting tomorrow. I really want the Fed to cut rates. Well, if the Fed cuts rates, it's because unemployment's going up, sales are going down, the economy's weakening. That's not a good place to be. So you don't necessarily want them to cut. You want them to fight inflation. You want them to maintain full employment to the degree that they can. And that's a good thing. So I wouldn't focus too much on whether the Fed goes up a quarter point, down a quarter point, holds another. I would focus on the economic fundamentals. And as long as those continue to be strong in the face of a slowing inflationary environment, that's a good thing. And businesses will continue to do just fine.
So it sounds like you think that there's still a possibility here where we could see a soft landing and avoid a recession.
It's definitely possible, but it's not a guarantee. So you might find, Jamie might be right, that the Fed has to hold rates or even raise again if it doesn't continue to decline. They might find that actually we have it under control and they can. But I wouldn't focus on what the Fed does. I would focus on what the economy does, because that's when you talk to small businesses, they don't say, wow, I was up late last night waiting for the Fed decision. They say, I was up late last night worried about how I'm going to make payroll this month, worried about how I'm going to find that next sale, worried about how I'm going to expand into that new location and find credit. Those are the things they worry about.
Well, we know that small businesses, though, a lot of them are obviously so reliant on the consumer. When we talk about rising rates, I know you said not to focus on rising rates, but when you talk about the impact that maybe is having or could have here on mortgage rates, not too far from 8%. Chair Powell talked about just the impact that could have on the economy yesterday. Jamie Dimon also weighed in on that just in terms of what the outlook looks like here for housing, a bit cautious there. What is that then impact or the trickle-down effect that could have when you talk about maybe a slowing housing market, what that then means for small businesses?
Well, look, a slowing housing market people have to remember, this is part of what the Fed is trying to do. Yeah. The Fed is trying to slow the economy because it got overheated. So we can't have it both ways. You can't say, why is the Fed slowing the economy and why is the Fed doing exactly what it says it was going to do, right? So we need it to slow a little bit, because if you want inflation to come under control, you need that excess demand to be, sucked out of the economy to some degree. To the degree that it pinches consumers' ability to spend and buy, there's no question that puts pressure on small business. But when we talk about those kinds of issues, there's also opportunities for small businesses. I've been saying for a long time, everybody wants to talk about the demand side of housing. What about the supply side? We need more housing. We've got a whole millennial generation that is in their prime buying years, and we're not building enough. And every time you build houses, those are business opportunities for small businesses. So we have to take both sides of that equation.
And Ben, that brings me to lending and what you're seeing here from small businesses. You talked about the fact that they're very optimistic. They're looking to expand. Those who are making investments, what are some of the trends that you're noticing at this point?
We see it depends on the industry. To your point earlier about housing, the industries that are closer to the consumer, think consumer retail, dining, restaurants, they are a bit more cautious because they are seeing pressure and the consumer is up against what they're able to spend. Where we really see strong investments is in business services still. Think technology, think consulting, think business services. We see huge investments in people, investments in buildings and infrastructure, and investments in equipment.
And when we talk about what it's going to look like here going forward, you mentioned some of the takeaways so far, the fact that business owners are very confident, they're very optimistic just about what the future holds. What is your message here as we enter what could be an unpredictable year when we talk about the election, the economy, and what exactly is going to play out here going forward?
Be prepared. And be prepared for those outcomes, but build your business and execute your plan. You know, everybody wants to talk about what else is going on out there that I can't control. And I have no time for things I can't control. I only have time for things that I can control. And so my message to small business owners is, you know what you do control. Control that in the wake of this environment, and you'll be resilient and you'll come through. And we see that in our clients.
Well, one thing that they cannot control, though, is regulations. That was also one of my takeaways here from speaking with small business owners, just the fact that some of the regulations that are in place down in D.C., how that's really restraining some growth or some of the complications, some of the challenges facing these small business owners. I'm curious to get your perspective on how the Biden administration has affected. Has it made it harder? Has it made it maybe a bit easier in some aspects for small business owners today?
I actually think, so if I talk about the Biden administration, I think the place where I see things getting tougher is actually on people like us, which has a downstream effect. So if I look at, for example, the Basel III recommendations that have come through and what that means for capital for banks, I think my personal view is it's gone too far. I understand we need more to be compliant globally, but I think it's gone too far. That'll put upward pressure on the cost of capital. That's not good. When you talk about regulations for small businesses, there are the things at the federal level like OSHA, but it's really important that we talk about state and local regulation. And there we see a pretty widespread. And part of the reason you've seen outsized business growth in places like Texas and Florida is because they have streamlined those regulations. They have made them easier. And small businesses have to navigate a web of regulations from the federal level to the state to the local level, but there's way more at that state and local level. And so I would watch what's going on around the country in terms of competition between states and how they're streamlining the regulations to make it better for small business.
And our thanks to our very own Shauna Smith there with that interview from Frisco, Texas. We are back live here from the NASDAQ in New York City. The markets have been weighing in on the recent jobs number this morning, as well as Federal Reserve Chair Jerome Powell's pause on rate hikes and geopolitical tensions out in the Middle East. And in light of the recent market turbulence, our next guest says there are more than 30 companies that have been able to consistently raise their dividends over the last 50 years, leaving our guests believing that these names may be recession kings. And the firm is out with a new ETF, Roundhill Dividend Monarchs ETF. To underscore that point, let's bring in Roundhill Investments Chief Strategy Officer Dave Mazza to discuss. Dave, you've got our viewers listening now. Recession kings, who are we talking about?
Yeah, we're talking about companies that are truly battle tested. So the Dividend Monarchs ETF, which we launched yesterday, the ticker is KNGS. And it's named that for a reason. These are companies that have been able to reward shareholders by increasing their dividends over the past 50 years, every single year. So these companies have been through wars. They've most recently worked through a pandemic, financial crises, bubbles bursting, what have you. And all along, these names have been able to increase their dividends. So it results in 36 companies. These are all high quality names, high return on equity, strong cash flow so that they can support that dividend. And in a time of crisis and stress, those are the type of names that tend to hold up much better than the high-flying growth stocks, which have been rewarded most recently.
And so when you think about how this would do if we didn't see a recession, then that's, I guess, the other side and the other kind of consideration that you have to weigh. So what is the likelihood of a recession that you're estimating at this point in time, so much so that it would make sense to kind of basket these names together?
Yeah, no, I think that's a good point, right? So when we think about names that tend to be more conservative, if we look at the variability of their earnings, meaning is one quarter are they doing $5 per share and the next $1, these companies are consistent. They've been through it all. And so in times of stress, in a recession, the kings are companies, the monarchs are companies that have stable demand. So Coca-Cola, PepsiCo, 3M. These are some of the names you're going to see in the portfolio. But what's interesting is, in a market that is just focused on growth, and names like this would underperform. But if we take a step back and say, what makes sense for the long run? What makes sense for my portfolio as a core holding? Names like this can be incredibly beneficial because you tend to lose more than the market in a down market. So over the long run, that compounding can be particularly powerful for investors. When I think about forecasting recession, everyone was wrong this year, right? Every economist thought a recession was coming. What's interesting here is that maybe we're finally starting to see it in the jobs number coming out this morning. We know we've been in a bit of a stagflationary environment where growth has been there, but it has not been widespread. I believe we've actually been in an environment of a rolling recession, and the next leg may come for the consumer next year. That's probably when we'll officially see that recession dated by agencies. But what's interesting is, even without that, I think investors are beginning to realize the gains have come from just really 7 stocks this year, and a handful of companies have driven the market higher. Without those magnificent 7, actually, the markets would be down. And so looking ahead, investors, I think we're hearing from them, are looking for opportunities for them to take a step back, have more safety in their portfolio, more consistency, like you can find with the dividend monarchs.
Dave, where do you stand on the Magnificent Seven?
Well, it's interesting. When I think about the near term, that's been the place where investors have considered the Magnificent Seven to be blue chips. What's really fascinating is there are names that this year, if you actually decompose perhaps why they've done so well, that's where the revenue growth has come from. That's where the earnings growth has come from. And in a time of uncertainty, investors have said, hey, I'm not really going to consider any other companies other than the names I know. And they've been the 21st century blue chips. And so perhaps that still makes some sense to allocate to these names in portfolios. But look at Apple's numbers last night. Some of the other Magnificent Sevens that have reported, of course, NVIDIA is still to come. They're saying that their growth is slowing. They're still putting up incredible numbers of revenue growth. But how much more can we pay up for flat revenue growth in 2024, like Apple is generally predicting, particularly with uncertainty coming from really strategically important markets like China? So these companies aren't going away. They're incredibly important to our economy. But if I think about valuation, now may be the time as we start positioning for next year, positioning for what may be inevitable from a recession standpoint, that may be an opportunity to take some profits in those names and look toward companies that have perhaps been out of favor, but have the added benefit of being incredibly high quality. And the 36 names that have been identified as dividend kings, which is really only 2% of the S&P 1500, so the large, mid, and small caps across the market, could be really beneficial because it's going to be an opportunity for investors to reduce the over-concentration that perhaps has occurred across broader markets, and have the added benefit of an increase in dividends, double that of the S&P 500 from a yield perspective, and companies that have just been through it all.
Yeah, some of those Magnificent Seven, if not all, I believe, might be in that METV, the Roundhill Metaverse ETF that we've discussed previously here, and I believe is doing quite well on the year as well. Roundhill Investments Chief Strategy Officer Dave Mazza. Dave, always great to get some of your insights here. Appreciate the time.
Thank you.
Thanks. All your markets action ahead, live from the NASDAQ market site. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation, mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Welcome back, everyone. We're live from the NASDAQ market site in New York City. U.S. Secretary of State Antony Blinken back in Israel this morning, meeting with Benjamin Netanyahu and other senior Israeli officials as a worsening civilian toll that fuels mounting concern that the conflict could widen in the region. And Americans are taking notice. An overwhelming majority of voters are worried the U.S. will be drawn into a military conflict in the Middle East, according to a Quinnipiac University national poll. The degree of concern varies by party, with more Republicans worried about U.S. involvement than Democrat or independent voters. Joining us now with more, Yahoo Finance's Rick Newman. Hey, Rick, what do we know so far?
Hey, guys. I think those 84% of voters who are worried about the United States getting dragged deeper into this war are pretty much right. I mean, that is a legitimate concern. And, you know, the Biden administration has sent 2 carrier battle groups to the region. There are more troops going there to secure U.S. bases and stuff like that. So, yes, it is that serious. But when I see things that people are worried about, I think back to what it means for how people think about the U.S. economy and for Biden's overall approval rating. And the reason is that Americans give Biden basically poor marks on his handling of the economy. And many pollsters and economists say that just doesn't reflect what's actually going on in the economy. There's this increasing scrutiny of why are Americans so bummed out when the job market is so strong, inflation has been coming down rapidly. We just had a blowout GDP number for the third quarter. That was based on consumer spending. And there's some thinking, the Wall Street Journal had an article on this recently, that people are so bummed out about things happening outside the economic realm that is affecting their view of things that are happening inside the economic realm. And Americans just think things are terrible. Confidence levels, consumer confidence levels are at recessionary levels. And we are not in a recession. We're not even close to a recession. Jobs report today, pretty good. The unemployment rate's still below 4%. But when I see this, 84% of Americans now worried about the U.S. getting dragged into this quagmire in the Middle East. That tells me people are going to probably get even more sour on the economy, and Biden's approval rating could go down rather than up, even though he's getting pretty good marks for his handling of the crisis over there so far.
Despite that, Rick, you have the U.S. House just passing a $14 billion aid package for Israel. What are the chances the Senate takes that up and the president ultimately signs it?
It's not going to happen the way the House passed it. And the reason is that House Republicans say, well, we need to offset that $14 billion in new spending by cutting funding for the IRS, which basically just means the tax cheats, wealthy tax cheats, would have an easier time fooling the IRS and getting away with tax cheating. This is completely ridiculous and irresponsible to say, let's come up with the funding for this by cutting IRS funding and allowing more wealthy Americans to cheat on their taxes. It is absolutely illogical. And Democrats who control the Senate have said that is such a stupid way to approach this. We're not even going to consider that legislation. So that bill is going nowhere in that form. They did approve about the amount of aid Biden wants for Israel, but they did not approve any of the aid he wants for Ukraine, which is about 4 to 5 times more than he wants for Israel. And Biden wanted some funding for Taiwan as well. So what's going to happen is the Senate is going to produce another bill, and it's going to include most of what Biden is asking for, maybe not exactly the same amounts of funding, but pretty close. And then we're going to have a showdown between the Senate and the House. And this is going to be the first real test for the new Speaker, Mike Johnson, how he performs in the big leagues, if you will. So he's done a good job pandering to the small number of hardline conservatives in the Republican Party. That's what this bill is about. But now he has to play realpolitik with Mitch McConnell, Senate Minority Leader in the House, who wants funding for Ukraine, does not want to attach IRS defunding to this. So we have a legislative showdown coming, and I don't assume this is going to get handled quickly. I think there's a chance this could go on for weeks, and it could be part of a possible government shutdown coming in less than 2 weeks. Lots to look forward to.
November 17th is the deadline. A reminder, Rick Newman going to stay on top of all of that for us. As always, thanks so much.
Bye, guys.
Let's do a quick recap of this morning's jobs report. The headline number coming in at 150,000. That's how many jobs were added in the U.S. economy in the month of October. Unemployment ticking up just a little from the 3.8% to 3.9%. Average hourly wages also up year on year at 4.1%, up just slightly more than expected there. We've been watching the market reaction throughout the day. Brad, you could say that it's sort of a positive, but not quite, right? When you think about the market reaction here, up about 120 points right now on the Dow, the S&P 500 up 27, and the Nasdaq up 100. The question is, of course, what does this all mean for the Fed? Is this kind of the resilience we're going to continue to see in the labor market?
Yeah, perhaps the market's looking at this as some type of bad news actually being good news in terms of looking at the data and seeing where we did miss on some of the expectations, whether that be the headline print or whether that even be unemployment rate, which actually was higher than expected. All that considered, it was only kind of moderately higher in each of those instances, even in the wages year over year, 4.1% versus 4%. So we're kind of splitting hairs in a few of those categories when we get into it. But it's really some of those broader trends here. And one of the areas that we were seeing those trends really play in, especially on the sector front, job gains occurring in healthcare, government, social assistance. Notice I didn't say leisure and hospitality. That was one industry that had been tracked.
Huge gains back in September.
Exactly, and which was continuing to come back off of the hit that it took, the most impacted over the course of the pandemic and on the onset of that. And so that had continued to be battling back. This is one of the first times where that really hasn't been the major call out or the major additive towards the job gains here. But all that considered, you did see a slight tick lower in labor force participation rate, which is interesting and worth keeping tabs on going into future reports.
Yeah, I mean, broadly speaking, the trend has been lower, right? When you think about the economic data points that the Fed looks at, obviously the jobs report, you think about inflation, but it is about the stickiness that continues to persist there, even if we're talking just off of that 2% level for inflation. The question is, with the labor market continuing to remain strong, you know, what does that mean for inflationary pressures, particularly around wage growth?
Absolutely.
Okay, that does it for Brad and I on this Friday. Brad and Shauna Smith going to be back here on Monday for you. Rochelle Akufo, not Rochelle.
Yes, Rochelle.
Rochelle.
Yes, Rochelle.
Going to be
that
around
Rochelle.
for the next hour.
Rochelle.
Yahoo Finance coverage continues.
Homie Rochelle.
Right here.
You got it, Rochelle.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. A solid number. Payrolls growth slows to 150,000 jobs in October, less than the 180,000 expected. The gap could be neatly explained by the impact of the UAW strike, but that wasn't the only one leaning on the economy. We'll discuss this hour. And beyond FTX, Sam Bankman-Fried found guilty of 7 counts of fraud and conspiracy, but the crypto industry will churn on regardless. Cathie Wood still betting big on Bitcoin, and amid the regulation debate, we hear from a senator who says the SEC is overreaching. Plus, House of Pain. Goldman Sachs revising its housing forecast again, dropping a new note that sees home prices falling 1% through the end of the year. Is the American dream still achievable? We'll get the full details this hour. But first, let's check in on the market action an hour and a half into the trading day. Looking at green across the board here, but a little bit of volatility this morning. We're seeing the Dow here up about 164 points, or about 0.5%. S&P 500 there up about 0.8%, or about 34 points. We're seeing energy the biggest laggard there sector-wise. Tech-heavy Nasdaq there seeing the strongest gain so far this morning, up almost 1% on the day, or 128 points. Let's also check in on the Treasury market there as well, because that's obviously something that the Fed will be watching. Continuing to see a pullback here, the shortest term 5-year yield of about more than 2.5% there. The 10-year still retreating from that 5 mark that we saw earlier in October, currently down today about 2.5%, and the longer term 30-year yields, that's down about 2% on the day as well. Well, the payrolls report coming in at 150,000 jobs added in October, that was below estimates. Economists were looking for 180,000 after September's blowout report. But the big question, would strike action in the United States distort the number? Well, the BLS said around 30,000 UAW workers were off the job at the time it conducted its survey last month. And that's a lot of paychecks that are not being accounted for. Now, the biggest monthly increases came in the government, education and healthcare sectors, the latter itself not immune to the impact of industrial action. Joining us to break it all down now, Yahoo Finance's Alexandra Canal and Anjali Kemlani. Big welcome to you both. So let's start with you, Ali, in terms of how we saw that impact from the strikes with the actors as well as the UAW strike as well.
Yeah, both of those strikes registering a hit to the monthly jobs report in October. And I want to start with autos because that was the more significant of the two. According to that BLS data, employment in manufacturing increased by 35,000 in October, reflecting a decline of 33,000 jobs in motor vehicles and parts, quote, that was largely due to strike activity. This was the first time that the auto strike impact had been felt in any of the monthly jobs reports, and it's likely that we will see that continue the longer the strikes go on. There have been positive signs that we could see an end to this strike after General Motors reached a tentative agreement with the UAW union earlier this week, joining Ford and Stellantis. The union's GM National Committee will vote Friday, today, on whether to send the tentative deal to its membership. And then if we go from Detroit to Hollywood, employment in motion picture and sound recording industries decreased by another 5,000 as Hollywood actors remain firmly on the picket lines following the conclusion of the actor strike last month. Now, employment in those industries fell by 7,000 in September and 17,000 in August. And since May, which is when the writer strike first began, employment in those industries has declined by 44,000. Now, the actors union SAG-AFTRA is continuing its negotiations with studios. It does seem possible that we could see an agreement reached by this weekend, maybe even next week. Still TBD on that front. But all in, strikes have cost the U.S. economy more than 75,000 jobs so far this year. And with both of those strikes still ongoing, it's likely that there's more pain to come.
Indeed, because I know we were wondering how this was going to start showing up in the jobs report, perhaps if not this one, as they were mentioning in terms of when it was calculated, what we'll see show up perhaps in the next jobs report. Angela, I want to turn to you because when we look at the job gains that we saw in healthcare, strong number here, 58,000 new jobs, but talk about the strike action versus what we also saw with the jobs growth.
Yeah, of course, we know we were tracking that huge strike in Kaiser Permanente, the 75,000, but that didn't make it into this reference period. In fact, it just got resolved on the day that this started, so they missed it. But there is still just one notable strike. That's the RWJ Barnabas in New Jersey with 1,700 employees still on strike there. So that makes up a small portion of this report. As you noted, 58,000. Really a large number, but not something that is particularly surprising, even with the pressures of the strikes, of the ongoing demands of healthcare systems, the pressures they face from pricing, from inflation, and not being able to, like in other industries, raise prices accordingly, being at the sort of the behest of insurance and payers. They aren't able to make it all up and make it whole. So that's been the problem. Added to which you have 10,000 baby boomers being added daily to the population, the aging population, putting even more pressure and demand on the labor front. And of course, since the pandemic, we've seen the pressure that this has put on the labor force, the burnout that has been happening. And as a result, the reduction of the labor force, broadly speaking, hospitals closing down. So it's a very mixed picture when it comes to what these additional pressures are. And yet, despite all that, you're seeing the gains in those jobs. So it really just is, a time period where these hospital systems, these health systems, these facilities really have to figure out how to hire up and continue that hiring trend. I've talked to some analysts who say that at least for the next decade, we're definitely going to see strong healthcare jobs growth as a result of all these pressures.
Indeed, I know that issue of the demographic shifts not being reported on enough, so I'm glad you brought that up. Appreciate both of you breaking that down for us. Anjali and Ali, thanks so much. So payrolls growth slowed in October, but RSM's Joe Bruselas called it another rock-solid jobs report. Now, the unemployment rate had been seen as a more accurate signal this month due to the impact of the workers' strikes, that number ticking higher to 3.9%. So what does this all tell us about amid the recession versus soft landing debate? Well, joining us now is Julian Brigden, Macro Intelligence 2 Partners co-founder and president. So Julian, where do we find ourselves in this discussion then?
So I think I find it very hard, I must admit, to construct a scenario where we essentially avoid a recession. I think one of the things that people don't understand is, in an environment where we have quite high sticky inflation, which is certainly what we think, but you find yourself in an unusual situation of having extraordinarily low unemployment. One of the things really you should look at is not just inflation, but look at nominal GDP. And when you do that, nominal GDP is remaining extraordinarily robust. And the reason you look at nominal GDP is because then you have to kind of parse this between inflation and real growth. So if, let's say, we get very low inflation, everyone would say, well, that's a great scenario. But the problem is if nominal GDP remains unchanged, real growth has to accelerate. That's just how the mathematics work. And it's very hard to accelerate real growth when you've got sub 4% unemployment, because the risk is that all you will do is you'll stoke wages again, and you'll end up back with those core inflationary pressures coming through. So I really think we need to continue, and the Fed needs to continue to grind this thing out. And that will inevitably weigh on momentum. And I think we are seeing some signs of that. I don't want to get too bearish at this point, but we are starting to see in this slight uptick in unemployment a beginning of a loss of momentum. Because if you go back and you look at a chart of unemployment, it's quite a strange beast. It kind of looks like a sort of scene that you would see in the mountains. So very sharp peaks, slightly rounded bottoms, and then you rise up again the other side of the valley. And that's where I think we are now. We're in risk of doing that and rising. We are not yet at a danger point. That would take an uptick if you lose the historic data to about 4.1 in unemployment. But we're definitely bleeding a little bit of momentum. But I think the Fed needs to keep hanging in there to do that, I think, unfortunately.
And something else that we're looking at with the Fed, they're allowing US Treasuries to mature and roll off their balance sheets versus buying new bonds. But when you look at the biggest buyers of US Treasuries, Japan, China, especially China, who were the biggest buyers here in terms of the momentum, pulling back then. What are the expectations here? Because you talk about the potential for a structural bond bear market. Break that down for us.
So we've believed really since 2016, and obviously you get caught a little bit by COVID, that we've essentially been in a structural bond bear market. And I think a lot of people focus particularly on the supply side, right? We've got an awful lot of debt coming out. Someone needs to buy it. That's what they focus on. What they don't look at is who is available to buy. What's the pool of global savings available to buy that? And if you look at the pool of global savings, certainly after allowing for capital replacement, it's actually been pretty static since 2011. And as you just discussed, within that, the two big players, kind of Japan and China, their positions have been shifting. So Japan's been relatively flat. Yes, they are rolling over their treasury exposure, but China has been the big growth point, and they aren't so favorably inclined to buy US treasuries. In fact, we've been seeing them selling. So there are two sides to this equation. We're trying to sell more debt into the market as that pool of available savings is shrinking. And the demographics actually dictate that it does shrink, because in most parts of the world, there's an awful lot of people who have retirement funds and retirement pensions. And unlike the US, where they tend to be very heavily invested in equities, in most countries, they're pretty heavily invested in bonds. And when you come up to a certain age, the government dictates that you start to liquidate those portfolios. And I think that's the point that we are now, where we're seeing just this tipping, this natural demographically driven tipping point, which has been exacerbated by some geopolitics and obviously this sort of division back into the world of a Cold War, where the Chinese just aren't buying our debt to the same degree. So that's why we believe we're in a structural bear market. Doesn't mean we go straight up. Our target when we sold bonds back at the beginning of August was 5%. So we kind of got lucky when we hit that. But it does mean structurally you're in a very different world.
And obviously, we have seen bond yields pulling back so far, especially over the last week or so. But it's interesting because you note that markets are still not understanding the Fed policy here. The Fed following the Greenspan strategy of opportunistic disinflation versus what we see with Volcker. Being that the markets don't seem to be pricing this in, what's your outlook for the rest of the year as perhaps reality does sink in?
So, look, I mean, if we get some sort of dramatic slowdown, I think it's possible that we can get rate cuts. But as I said, we're losing momentum, but there's nothing very dramatic yet at this point. There still seems to be an economy that is relatively robust. And in that situation, if you're pursuing this sort of opportunistic disinflation, so basically, rather than the Volcker sort of deliberate disinflation, where you take that terminal rate and you really ramp it to an extraordinary high level so that you essentially kill the economy, the big payback on this strategy is you trade that ultimate level of terminal rates for an extended period where you hold rates restrictive. And I think the market still desperately wants to believe that we're just going to walk rates up, things will slow down, and then the Fed will immediately cut. And you don't do that in this policy framework. I mean, if we go back and we look at the Greenspan period in the late 90s, where he pursued this policy, and inflation was lower, and he also got extraordinarily lucky with a huge explosion in productivity. Maybe we can get the same thing through AI, but he kept rates basically unchanged for 4.5 years. And yet, if you look at what the SOFR market, or the sort of short end of the US curve, is pricing in, they're still pricing in pretty aggressive rate cuts. And that's not consistent with a non-recessionary outcome, which certainly the equity market isn't pricing. So we're still playing this game of equities want to rally, bonds, need to price that against them. And then when bonds rally, you get into this sort of push me, pull me game between these two markets.
We'll certainly continue to watch how that plays out here. But as you mentioned there, markets at least not really understanding the Fed policy at this point. Julian Brigden, Macro Intelligence 2 Partners, co-founder and president. Thank you so much. Have a great weekend.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear
Silicon
this
Valley
week.
Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates.
The diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust.
Don't miss it, November 7th, exclusively on Yahoo Finance.
Sam Bankman-Fried has been found guilty of all 7 charges he was facing, including wire fraud, securities fraud, and money laundering. He'll be sentenced in March. Now, much of the debate now, should this be seen as an idiosyncratic case of fraud, or does it tell us anything material around the wider sector? Well, some names are remaining bullish. MicroStrategy founder Michael Saylor saying Bitcoin ETF approvals would be a catalytic event with wide-reaching benefits, opening doors for more asset class adoptions. And ARK Investments' Kathy Wood reiterating her view that she would wager on Bitcoin to safeguard against possible deflation. Let's bring in Yahoo Finance's Jennifer Schonberger with more on what she's been hearing about regulation in this space. Hey, Jennifer.
Thanks, Rochelle. Good morning to you. In the wake of Sam Bankman-Fried's guilty verdict and the collapse of FTX, Senator Cynthia Lummis told me in an exclusive interview Thursday that is all the more reason for a clear new regulatory framework for crypto. She told me she believes as some of these investment houses like BlackRock and Fidelity seek approval for a spot Bitcoin ETF, that could help push things faster. She told me she believes her very own comprehensive crypto legislation co-sponsored with Senator Kirsten Gillibrand could get a vote early next year. Take a listen.
It's important that we pass Lummis-Gillibrand as soon as possible, hopefully early in 2024, because it's the complete regulatory framework for digital assets. Now, I'm absolutely open to having it passed in segments, we put the illicit finance component of our bill in the NDAA with input from other members. We could put the commodities portion into the farm bill. So that would be the Bitcoin specific portion of the bill. We could move some of this through the Finance Committee, some through the Banking Committee, but we're crying out for a clear regulatory framework here. Now, something that might help break the logjam on this is that certain traditional financial institutions like Fidelity and BlackRock will be approaching the SEC relatively soon, we believe, to request authorization for a Bitcoin exchange-traded fund. And so as you see these traditional asset managers move into the digital asset space, I think that that is another indication that it's time to have a clear regulatory framework. So in the meantime, Senator Gillibrand and I will continue to push on the case for digital assets and a complete regulatory framework at the same time that we encourage the Justice Department to complete their investigation of Binance and Tether that were involved in the illicit finance of Hamas because their platforms were used, and it looks like they turned a blind eye to that. Another thing that's happening with Tether is their stable coin is a significant holder of U.S. Treasury bonds. So because they are a big enough player in that space, there's some risk to the U.S. Of having this stablecoin unregulated. So we've been really working with Patrick McHenry in the House to get the stablecoin component of our bill moving. And we're flexible. Senator Gillibrand and I see the small differences between the House and the Senate versions, specifically related to stablecoins. We know they're resolvable. And we're flexible with regard to that. So I think we're going to be able to get to a resolution on stablecoin now that the U.S. House has this wonderful new speaker and they're again open for business. We think we can turn our attention once again to the stablecoin component of our bill, possibly even still before the end of this calendar year.
What about, you mentioned the stablecoin portion, but we also know the House Financial Services has put forth their own framework for regulating crypto, something that would garner support on the House floor, assuming we can get this government funded in time, perhaps as soon as this year on the crypto front. Is that something you would support as well?
Well, I am extremely supportive of whichever body, the House or the Senate, can move this legislation first, that they do so. Whoever has the political will to begin to move this forward is fine for me. I am very flexible, willing to work with the House committee. And in fact, we've been in touch with the House committee, Democrat and Republican leaders for months, and we stay in touch with them and our staff stay in touch with them. So these things aren't happening in a vacuum between the House and the Senate. They're happening with constant coordination between the House and the Senate.
And Senator Lummis also told me on Tether that she wants more transparency because Tether holds so many U.S. treasuries, perhaps in some cases more than other countries, and wants to understand whether that poses a systemic risk to our financial system. She also wants to learn who the U.S. corresponding bank is here on Wall Street for Tether. Michelle?
All right, appreciate that update. Yahoo Finance's Jennifer Schonberger. I know people will be eagerly awaiting to see if we see that AI legislation go through.
Yeah.
Right, now shifting gears to some movers and one business battling off those higher rates. Online used car giant Carvana defying the economic headwinds to beat the street in the third quarter, reporting earnings of $148 million on revenue of $2.77 billion. Shares in Tempe, Arizona's finest are up over 500% year to date. Now, they started gaining traction after it became clear a debt restructuring would avoid default, at least for now. Joining us for more Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, and what a stock this has been this past year. So Carvana right now is up about 12%. Part of that could be also a short squeeze because it's a heavily shorted stock, but also after the company's surprise profit with adjusted earnings per share coming in at $3.60. The street was expecting a loss of 78 cents per share. Now, what analysts are paying attention to are units sold. So for the quarter, the company sold 80,987 units. That's 6% higher from the prior quarter, but still 21% lower than the same period last year. And that is why you have some analysts that have cut their price target on this stock. As far as total gross profit per unit, or GPU, that jumped 70% year over year to $5,952. So the company really touting that GPU unit. But as far as going forward and what they're expecting for this quarter, Carvana is expecting a decline in retail units sold. That's primarily because of industry and seasonal patterns. And Ernie Garcia, the CEO of Carvana, saying that it's really hard to tell right now because you have had a couple of years where there's been a lot of distortions with the price of the cars that shot up back in 2021. Then you had interest rates last year that were moving higher. So, but they are seeing that over the last 4 weeks, they are seeing a little bit of a slowdown. Now, this stock, getting back to the stock, as we have mentioned, up 12% today. I'm looking at a year-to-date chart right now, 600% year-to-date. You can see that back in July, year to date, back in July, the stock was up 1,000%. Short sellers were down $2 billion because of their bets on this stock. So it had gone up to more than $50 a share. Remember that this stock last year, at the end of last year, was trading close to $4 a share amid speculation of a bankruptcy. And they have turned things around, but really Carvana being laser focused on profitability over growth right now, really driving home the point of profitability, guys.
And certainly paying off when you look at that stock price and that stock action. Great stuff. Thank you for that update, our very own Ines Ferre.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. The El Nino weather phenomenon has contributed to a severe drought at the Panama Canal, leading to the driest October since records began back in 1950. Now, the Panama Canal Authority has been forced to cut daily ship numbers. During normal times, the canal sees 34 to 36 ships daily. And by February 1st, that number will be cut by about 50% to 18 ships. The low water levels have caused delays, prompting price increases for shipments. Joining us now with his insight on the matter is Josh Ironman, U.S. Energy Information Administration industry economist. Thank you for joining us this morning, Josh. So put this in context for us in terms of this seems to be an issue that was sort of already in the making, but we're continuing to see this coming to the forefront. What is at stake here where we see what's happening with climate change and how it's impacting shipping and shipping costs?
Absolutely. Just to put into perspective, the normal number of transits that go through the canal range from either 36 to 38. So by February, this will be cut by more than half. What is happening is because of the fewer ships that are able to go through the canal, some ships are now taking longer routes to get to their destinations. So, for example, if a shipment is going from the US Gulf Coast to East Asia, some ships may choose to go through the Suez Canal, or they may choose to go around the Cape of Good Hope. So what we're seeing is that there are more ships now being taken out of the market, and then this is causing rates to be higher, among other factors.
So Josh, break down some of the domino effects, because if you look at the type of the commodities that go through the Panama Canal, especially these very large gas carriers that includes liquefied natural gas for the US, have we already started seeing that showing up in the pricing for LNG?
So for LNG prices, I'm not sure. However, for very large gas carriers, these carry mostly propane, butane. These are prices I have access to. These are rising quite a lot. However, the market did cool off a bit. So what we see is with the freight market, we can see prices going up, and then at a certain point, prices reach a level where charters and market participants will start to back off of the market. So then those prices will start to then decrease a bit. However, with the new restrictions that were put in place, we're seeing those prices now again start to pick back up. And of course, there's ships that have booking slots already that they booked ahead of time. And then I imagine now these booking slots are getting cut. So then that is going to push the vessels that are getting cut from the booking slots that they've already had booked to be now pushed further back. And then again, this is probably going to end up causing more delays at the canal.
And it certainly doesn't help that this is coming at a time when, most of the world is still experiencing high inflation. And as you noted there, when it comes to these bulk shipping companies, they have a couple of options. You can wait the extra days. You can pay, in some cases, up to $2 million to try and jump the queue in the line, or take perhaps a longer, more costlier route, but all costly whether from a financial perspective or from a supply chain perspective. Are we able to quantify how much that's changing and how much of that ends up being passed on to the end user or consumer?
So it's interesting because for propane, again, for example, we're not really seeing much of a change in propane prices, wholesale prices that are getting shipped. For container ships, because of the draft limits that have been imposed, these are making it so that vessels have to sit higher in the water. So to achieve that, a container ship then has to take containers off of the ship to then sit higher in the water so that they're not as low. And I imagine that that's having quite an effect in that industry because if it's not very economical for a container ship to be carrying 40% less of its capacity when it's going, all the way from East Asia through the Panama Canal to, say, the East Coast in Georgia or something.
So, Josh, I want to ask you, in terms of long-term solutions here, obviously cutting the number of ships is one. I mean, the New York Times estimating that the passage of one ship consumes as much water as 500,000 Panamanians use in one day. That's just from one of these ships. In terms of long-term solutions here, what are we looking at here other than cutting ships, and who could perhaps benefit from that?
So it is important to keep in mind that the Panamanian people also get their water supply from this lake. About, I believe, half the country gets water supply from there. And they also have hydro power that goes through the lake as well. So this is not just having an effect on the shipping industry, but this could have effects for the people of Panama as well. One long-term solution that I've seen floated around was building another reservoir for the canal. This would cost about $900 million. But in context, next year they're planning on, or the Panama Canal is expecting to lose revenue of about $200 million. So as a long-term solution, it seems like a pretty economical way of handling this. However, the building of the reservoir will take about 5 years, and it still has to go through the National Assembly and the government of Panama to reach that decision to build that.
We'll continue to track that. I remember the ship that got stuck in the Suez Canal. They would talk about the domino effects of cost there, so something we'll continue to keep note of.
Yeah.
Thank you for joining me this morning, Josh Ehrman, U.S. Energy Information Administration industry economist. Thank you so much.
Thank you so much.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust.
Don't miss it November 7th, exclusively on Yahoo Finance.
Goldman Sachs is revising its housing forecast again, dropping a new note this week saying it sees home prices falling 1% through the end of the year before appreciating by 1.9% in 2024. Well, let's bring in Yahoo Finance's Danny Romero to help break this all down. So, Danny, what are the big takeaways here?
Rochelle, Wall Street has hit a little bit of a frenzy mode in slashing some of their year-end forecasts. Let's start with Goldman Sachs. In late September, the investment bank said that home prices would appreciate by about 1.3% at the end of this year. That's if the Case-Shiller index reported a 1.3% decline in the last 5 months of this year. Well, guess what? That didn't happen. Case-Shiller reported another record high in August. Home prices increased 0.9% month over month in August. It's also really important to note that the Case-Shiller index does have a lagging effect. And so the numbers we're seeing is from the summertime when mortgage rates were about to breach that 7%. That is to give you some context on what those numbers are reflecting right now. So with that in mind, Goldman Sachs is quickly changing its mind, and now Goldman expects home prices to appreciate by about 2% for the full end of the year this year. That's if Case-Shiller reports home prices declined by 1% in the last 4 months of this year. We have to wait and see if that happens. But moving forward for next year, looking onward, home prices are expected to appreciate by about 1.9% for the full year. And even further, I think this is a really bullish call from Goldman Sachs. But looking into 2025, Goldman Sachs expects home prices to be up by 2.8% for the full year. That's seasonally adjusted, remember. So really no relief, Rochelle. Goldman Sachs expects also affordability to be could improve over the next 3 years.
So Danny, then what are we seeing with mortgage rates? Obviously, if you're trying to get into a home, what are the forecasts here?
Goldman Sachs is once again changing up their forecast. I think this is something that's happening across the board. But again, they're expecting in late September, the investment bank said that mortgage rates would land at 7.1% for the end of this year. Scratch that out. Instead, their baseline forecast for the 30-year fixed mortgage rate will land at 7.6%. That is pretty high. It's headed towards that 8%. And for 2024, they're expecting that mortgage rates will land at 7.1%. So a little bit relief. And if we look to 2025, Goldman Sachs expects that mortgage rates will land at 6.6%. But there are two reasons on why there is this switch around. One is that yields on the long-term dated bonds, they've been pushing up higher, and they have been drawing closer to the short-term bonds. And so remember, fixed mortgage rates are tied to the 10-year Treasury yield. And so there's been a lot of volatility there. And today there's been actually some pullback due to the jobs report. So the big movements in the bond market are really largely reflecting the strength in the economy, and also runs the risk that the Fed will hold rates high for some time. Another point that Goldman Sachs really points out for why they are changing their forecast for mortgage rates is the secondary mortgage-backed security market. They say that they've already been pricing a higher for longer in that mortgage rate environment. So really on the mortgage rate side, we could see more relief in 2025. Like I said, like they pointed out, it could end at 6.6%. But for this year, it'll end up pretty high at 7.6%.
All right, so I guess everyone has to have a little bit more patience and wait this out. Appreciate you getting us up to speed. Danny Romero, thanks so much. Well, the Fed's ongoing inflation fight continues to weigh on the commercial real estate sector. Global commercial real estate investments at Jones Lang LaSalle were down 48% year over year during the third quarter, impacted by a weaker transaction market thanks to high interest rates. But the company does remain focused on diversifying its core businesses as a way to offset losses during this challenged environment. And though Fed Chair Powell did signal the Fed may be done hiking at Wednesday's meeting, higher for longer rates could mean a long road ahead for the real estate sector. Joining us now with more is Christian Ulbrich, JLL's CEO. Thank you so much for joining me, Christian. So a lot of people wondering when we were going to start seeing this CRE recovery, and you actually pushed back your projections here. Talk about some of the factors that you're considering in that.
Well, first of all, we saw the interest rates spiking up roughly 100 basis points over the last 3 months. That was probably more than most of the market had expected in that short period of time. Secondly, the geopolitical environment has significantly worsened over the last 3 months. And with this environment kind of prevailing, investors will continue to be very cautious before they deploy more capital into real estate.
And as you noted in your earnings call, you have some more resilient business lines, at least trying to offset some of the losses and the softness that we're seeing. Talk about your plans there to expand your growth and the sort of investments you're making as you're diversifying some of these business lines.
Yeah, I mean, what I would like to say is, we are not making the market. We have to be actively working with that market and be agile in our reactions. And so we are overall very pleased with our performance in the third quarter. And as you rightly say, a large piece of our business are very resilient business lines. We have a very high market share in the outsourcing business, corporate real estate outsourcing business, and that did extremely well the whole year already and also in the last quarter. And we have the ambition to grow that business even more and become slightly less dependent on transactional revenues.
And when you look within CRE, obviously a lot of people focus on office vacancies in the office space, but it is a diverse set here. But do you think that the worst of what we've seen with office vacancies are behind us at this point?
That is really hard to predict because you have to look at the whole market. We tend to focus very much on the high end, kind of the grade A buildings in the large metropolitan areas. On that end, I would say we are probably at around trough. There may be a little bit of more vacancy, but not that much. And we see that market probably improving over the course of 2024. But there is a lot of office product out there, which what we would call commodity offices, where there will be more difficulty ahead for those type of properties. And in some cases, they are literally obsolete.
And so then as you look at how work has changed, and especially post-pandemic, a lot of the structural changes there, what are some of the ways that you're investing in the technology or really preparing for the future of work as it doesn't seem to be going back to business as usual? There are some nuances that seem to be here to stay.
Absolutely. I think we have to see the future of work as always being a hybrid between working from the office most times of the week, but also working from anywhere. And so we have to support our clients as much as possible to realize that, to create an environment where it's absolutely seamless, where some people are in the office and some people may dial in a conference call from home or whatsoever. And so there's a lot of technology out there which supports that. And to integrate that type of technology into the space of our clients is one of our large priorities. We have been investing heavily into that for many, many years, and we are taking now the benefit for that.
And as we look industry-wide, the slowdown in investments in sales and leasing transactions, we're seeing that persisting. Is that going to become a new normal, or what sort of investments are you making to sort of improve that growth?
Well, first of all, office is just one asset class, and it is the dominant asset class in the leasing business for us. But for example, in the investment sales business of ours and in the debt business of ours, we have a much bigger share towards residential and an equally high share towards industrial assets. And the residential space is still doing relatively good. The hotel space is still doing relatively good. Offices are lagging for the reasons I just described. And so we are building out our expertise in the more specific niche asset classes, which will be growing very heavily. Just think about data centers. That is an asset class which will continue to grow very significantly over the foreseeable future.
Well, I appreciate you taking the time to join me this morning. Christian Ulbrich, JLL CEO, thank you so much and have a great weekend.
Thank you so much for having me.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
2023 rocked the markets.
NVIDIA, the stock has been on a tear this
Silicon Valley
week.
Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest, the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
Concerns are not easing up for Apple. China's contribution to Apple's total revenue just hit its lowest point in nearly 3 years. On top of that, sales of the new iPhone don't seem to be off to a raging start either. But our tech editor Dan Howley says maybe, just maybe, services could be the savior the company needs. He joins us now. So Dan, explain. Services, they never sound quite as exciting as new product launches, but I'm curious here.
Yeah, they're not as hot to trot, I guess, as something like a new iPhone or a new Mac, but they do add a lot to what the company has to offer. So just quickly, let's go over what happened in the quarter. Obviously, iPhone sales met expectations, beat them just a hair, not exactly, blowing people away. We also had issues with the iMac as well as Mac, as well as the wearables and iPad businesses. But services really did knock it out of the park here. They had $22.3 billion in revenue versus $21.36 billion. That's up from $19.9 billion last year. And that's really the comparison that I think a lot of people are looking at is the year over year when it comes to the Mac, obviously down. When it comes to iPad, obviously down. When it comes to wearables, down. And so that's really where I think most people are concerned when they're, talking about the revenue being lower than they had hoped. This whole year of 4 quarters of declines for Apple in general, starting with Q1. But services has been a standout, and they continue to grow that. Now they're going to increase the price of Apple TV Plus. We'll see what that means for whether or not there's going to be more churn or not. They also are expected to have some big numbers, perhaps from Killers of the Flower Moon. That's something that is an Apple production, obviously, with Martin Scorsese and Leonardo DiCaprio. And then, moving past that, there's a few other kind of bright spots for Apple as well. The Mac, for instance, in Q1, Apple CFO Luca Maestri saying that the Mac should see an uptick going forward, and that's because of the new M3 chips in the MacBook Pro and iMac that are coming to users now. But there's still going to be problems with the iMac wearables, iPad and wearables divisions, just because they say of timing. There's a few other bright spots for the company, and I think those are worth pointing out, and that includes India. During the call, Tim Cook and Luca pointed out India as a big bright spot. They continue to invest in that region, not only as a means for manufacturing outside of China, but as a location for sales. They opened their 2 new stores, their first, I might add, in India this year in Mumbai and New Delhi. And according to Counterpoint Research, sales there jumped 2% year over year in India. Tim Cook basically pointing out that there's a growing middle class there. He didn't want to go into describing the kind of similarities or differences between China a decade ago and India now, but clearly they're trying to look more into India as a place for growth, not to mention places like Brazil and Vietnam as well. But India, with its massive population, could prove to be a big bet and win for Apple in the long run. I think the main things to look at are, obviously, people are concerned about iPhone sales. They weren't as terrible as anticipated. You could read into it, and some analysts are reading into the issue with China sales being down as being a result of the Mac and iPad and wearables services businesses being down. And so those really could be what's going on here rather than the iPhone itself. And market share appears to be, at least according to analysts so far, in line or not declining compared to Huawei. So overall, there are concerns, but it seems as though there's more, green shoots than were initially anticipated going into these earnings.
Indeed. Apple still with a considerable moat versus some of its competitors here, and still our top trending ticker so far this morning. Yes. Our top trending ticker also on Yahoo Finance right now. Appreciate you so much. Thank you, Dan. Have a great weekend. All right, well, let's get you a final check of the markets as we head into the noon hour. Looking at all 3 major indices currently touching session highs at the moment. The Dow currently up about 0.7% or 230 points. S&P 500, they're also up about 1%, about 42 points. We're seeing real estate the leader, energy the only sector in the red on the S&P. And of course, the tech-heavy Nasdaq, they're off to the races, currently up about 160 points or just over 1%. Well, that does it for now. I'm Rochelle Akufo. Thanks for watching Yahoo Finance. Stay with us.